Good morning, Superintendent. Good morning to all. I am Senator James Sanders Jr., and this is the Senate Committee on Banks. And today we are charged with finding out what led up to the collapse of Signature Bank. What happened in New York that led to this? We've heard all kinds of stories. We've heard theories from everything from it was something that no one could predict to something that everyone should have known to was it the Fed, was it the, let's see, more theories, was it bad management, was it the cryptocurrency, overvaluation of cryptocurrency. We've heard all kinds of theories. Today, we get a chance to delve into this matter to find out what are we dealing with, is it under control, and even more important, how do we make sure that it will never happen again? So I want to welcome you all to the public hearing on why Signature Bank failed and what can be done to prevent future bank failures in New York. I want to thank the members of the Senate Banking Committee and the witnesses who are participating today, as well as the general public who are here and who are viewing online. After my opening remarks, I will ask each member of the Senate Banking Committee if they'd like to make a brief statement. New York is the global center for banking and the broader financial industry. New York is the home of Wall Street. What happens in New York has impact on the world. After the failure of Signature Bank sent shockwaves through the nation as the third largest bank failure in American history, the public, of course, deserves an explanation. As we go through the journey of uncovering fact from fiction today, the Senate Committee on Banks will carefully listen to the testimony of witnesses who bring a variety of experience and perspectives to this hearing. Our job, of course, is to go and, without fear or favor, to find out what happened, to ensure that the people of New York are safe and that our banking system can weather this and any other storms. Among these highly qualified witnesses, we have the top New York State regulator for state-chartered banks, a leading co-author of the Dodd-Frank Wall Street Reform and Consumer Protection Act, a lot of words there. The federal act that overhauled the financial regulations in the aftermath of the Great Recession. And we have the chief risk officer for the FDIC, Federal Deposit Insurance Corporation, who wrote the official FDIC report on Signature Bank. And we have other witnesses too, and I want to thank everyone for that. I want to move along quickly. I have quite the statement that I'm not going to give at this moment because I think that the most important statement are the statements that the witnesses are going to come up with. And under those conditions, I want to say that, of course, we have been joined by Senator Jabari Bridgeport. We have been, the ranker will introduce not only himself, but his fellow Republican, and he can give a statement. Mr. Ranker, good to have you here, sir.
Thank you so much, Chairman Sanders. Appreciate that. I'm Senator George Borrell, the ranking member of the Banks Committee, and I'm joined by Senator Jim Tedisco. Just want to start off by saying thank you all for being here to speak on this. I think it's important that we understand that doing this is important because we need to ensure that going forward we are protecting New York State's financial system. And as goes New York, so goes the rest of the country in so many ways. I think people should understand that things are stable and that people are monitoring this at the state and federal level. And I look forward to having this discussion. I have questions I'd like to ask, as I'm sure you do as well. But I certainly appreciate, Chairman, you putting this together so we can have some public discourse on what happened at Signature Bank.
Thank you. Would you care to say something, sir? Senator.
No comments, just questions. Thank you, Mr. Chair.
Yes, I missed that one. How about you, sir?
No, I'll just say thank you, Mr. Chairman, thank the ranking member, and thank you for being here today. we want to make sure people have some faith in our banking industry here that is so important. So we want to listen, get an understanding of the direction we can take to bring that faith to the highest level possible, and that they can put their faith in that belief that the banking industry is going to go forward in a positive way. So we look forward to listening and asking a few questions possibly.
Thank you, sir. And without further ado, let us hear from our first witness, the Honorable Adrian Harris, who is the Superintendent of the New York State Department of Financial Services. Madam Superintendent, good to see you again.
Good afternoon, Chair Sanders, Ranking Member Borrello, and members of the Senate Standing Committee on Banks. Thank you for inviting me to the hearing today. On Sunday, March 12, 2023, Signature Bank failed after experiencing a propulsive run on deposits on Friday, March 10th. The run was instigated by the self-liquidation of Silvergate Bank on March 8th, and then the failure of Silicon Valley Bank on March 10th following an unprecedented run on its own deposits. Pursuant to Section 606 of New York banking law, DFS has the authority to take possession of a bank whenever the department finds, among other reasons, that the bank can no longer operate in a safe and sound manner, had violated the law, was unable to conduct business safely with expediency, or cannot make its payment obligations. In order to avoid a disorderly midday Monday shutdown and further contagion across the banking system, on the evening of Sunday, March 12th, DFS took possession of Signature and appointed the FDIC as receiver. Before its failure on March 12th, regulators had documented liquidity-related regulatory concerns to the bank, beginning with the 2018 report of examination. Despite orders from regulators, the bank was slow to remediate supervisory recommendations, and many issues identified by the regulators remain unresolved when the bank failed. Signature's inability to remediate the outstanding liquidity management issues undoubtedly contributed to its collapse. However, the immediate cause of the bank's failure was the unprecedented run on deposits instigated by the self-liquidation of Silvergate and the subsequent failure of SVB. On Friday, March 10th, Signature experienced a runoff of $18.6 billion in deposits in a matter of hours, reducing the bank's deposit base by 20%. Throughout the day Friday and into the night, the regulators worked closely with each other and Signature to find sufficient liquidity to satisfy the significant volume of customer withdrawal requests. After avoiding a default on Friday, regulators had time over the weekend to assess Signature's condition and come to a considered view as to whether the bank could open safely on Monday. DFS had one objective that weekend: to preserve the safety and soundness of the financial system. 3 paths were identified for the bank in order of preference. The first was to find a way for Signature to open in a safe and sound manner on Monday and continue as a stable institution. The second was to find a purchaser for the bank on an open bank basis. Third, DFS and the FDIC would work in parallel to prepare for the last resort scenario of taking possession of the bank and appointing the FDIC as receiver. The regulator spent the weekend collecting and evaluating information from Signature in order to make a data-driven decision about the bank's viability. DFS and the FDIC were in continuous communication with Signature executives, staff, and the board of directors. During a 1:15 p.m. call on Saturday, March 11th with Signature executives and the board, the regulators made clear to the bank that the bank's viability was uncertain and that the bank's best option at that point was to find a merger or acquisition partner as soon as possible. As a preparatory measure, FDIC staff presented the mechanics of a possible receivership or resolution. Regulators stressed the need for timely, accurate, and complete information to assess the condition of the bank. When Signature would not commit to providing information by a particular time, the regulators pushed Signature to provide the data no later than 4 p.m. that day. While a roll call was not taken on the call, the bank verbally noted that all board members were present. To open in a safe and sound manner on Monday, March 13, Signature needed to identify and pledge assets that were immediately acceptable to the Federal Reserve Bank of New York to raise the liquidity needed to meet outstanding and new withdrawal requests. Starting at noon on Sunday, the bank finally began producing a comprehensive liquidity plan for the coming week, which included a breakdown of the sources and value of liquidity, inclusive of new deposit inflows. However, the bank's liquidity plan was constantly changing. Between noon and 3:09 p.m. that day, Signature provided 4 different liquidity plans. The listing of available liquidity changed from plan to plan with no explanation for the change, and in a phone call on Sunday, March 12th at 1 p.m. between the bank CEO and DFS, the CEO focused the conversation on what regulators should be doing to try and solve the bank's liquidity crisis. Signature's inability to provide reliable data and a credible liquidity strategy to operate in a safe and sound manner on Monday led DFS to take possession of the bank and immediately appoint the FDIC as receiver. At the time DFS took possession, the bank had $4.27 billion of certain liquidity available for Monday morning to cover known withdrawals ranging from $7.4 to $7.9 billion. These withdrawal estimates do not include additional unknown withdrawals that could reasonably be anticipated on Monday in light of market conditions. Taking possession of the bank was the option of last resort to avoid a disorderly Monday shutdown midday and stop any further panic and contagion across the broader banking system. DFS-regulated financial institutions are safe and sound today, but the department has instituted heightened monitoring of banks with higher risk profiles and is implementing recommendations to modernize supervision of the global financial system. Thank you, and I look forward to your questions.
Thank you, Madam Superintendent. I have a number of questions, but I will ask just one, and I will come back to it later after my colleagues speak. The issue of crypto is going to come up, has come up, is coming up, and the issue of does New York State, is New York State not in favor of crypto? Is this one of the reasons that could have been why Signature Bank was taken over? Would you care to chime on that?
Thank you, Senator. It's an important question and has come up quite a bit in the months since the bank's failure. Crypto was not the cause for the failure of Signature, nor was DFS's animus toward cryptocurrency or cryptocurrency companies. DFS is the only prudential regulator of cryptocurrency in the country. We have the most robust framework here in New York out of DFS, and it has become a model for regulators around the country and around the world. In fact, our regulations necessitate a strong banking relationship for our regulated cryptocurrency entities. Signature's deposit base was much more diverse than the other banks that failed, but about 20% of the deposit base were deposits from cryptocurrency companies. And it's important to distinguish here that it wasn't cryptocurrency at the bank, but US dollar deposits of cryptocurrency companies constituted about 20% of the bank's deposit base. The run that we saw on Friday it was roughly proportional. The depositors that were withdrawing that day was about roughly proportional to crypto's proportion in the deposit base overall. So a little over 20% of the deposits that ran were cryptocurrency company deposits, but the rest of the deposits that ran on that Friday afternoon were from depositors across the bank's diverse depositor base.
Okay, I will come back. Thank you for that. My ranker, Mr. Senator Borrello.
Yes, thank you so much. Superintendent, thank you for your testimony. You know, I think you addressed in your opening statements what you thought the causes were of the collapse of Signature Bank. You know, there's been some criticism out there that perhaps, DFS acted too soon, but it sounds to me like after seeing 4 plans in the matter of hours and how they were going to meet those requests, it certainly seemed like a prudent thing to do. But, this is something that obviously should have been contained, it has been contained, but what is DFS doing to ensure the stability of the rest of the financial institutions in New York State and, leading up to that takeover of Signature Bank?
Yeah. Well, first, if I might, Senator, and thank you for the question. We waited as long as we possibly could, and you heard me outline our 3 preferences in order of preference, but it was the work of the regulators, myself, my fellow regulators in D.C. at the FDIC and the Fed that determined that if this bank were allowed to open on Monday in an unsafe and sound manner and had a disorderly open or day of business on Monday, that the bank certainly would have failed and we would have seen contagion across the country, potentially wiping out small and mid-sized banks across the country. And it's why the federal regulators took the extraordinary steps that they did in instituting the systemic risk exception to cover all uninsured depositors, and we are thankful for that. In terms of what we are doing now, there are several things that we have underway at DFS. We've identified a number of banks that had some of the markers of high risk, high percentage of uninsured deposits, a number of other risk factors that we've identified, and we require daily liquidity reporting from each of those institutions so that we can ensure that they have the liquidity necessary in the event that they themselves experienced a propulsive run. We have multiple calls every week with the Federal Home Loan Bank of New York to monitor lending that those institutions are undertaking. We have several calls every week with the Fed and the FDIC to get their views on the New York institutions that they also oversee. So we've done quite a bit. Also, as the other regulators have done, DFS itself published a report with a suite of recommendations about how we can modernize supervision, including tightening the feedback loop between examinations, make sure we're reporting out more quickly to institutions about our examination findings, and also designing new protocols to escalate issues more quickly to the leadership of DFS so that they can be addressed in a more timely manner.
Well, that being said, do you think if those, and those policies certainly sounds good, do you think if those had been in place, how would that have potentially impacted the, at least the timing of the signature situation?
Yeah, I'm not sure it would have changed the timing of the signature situation that weekend. It is, and it's always, of course, hard to speculate, especially given the historic nature of the runs. These were the biggest runs we've seen in banking history, first at SVB and then at Signature. I do think as we have gone back to look through exams from before my time as superintendent, making sure that we escalate persistent issues that bank executives do not remediate year after year, and making sure we escalate those and address those more efficiently is hopefully going to go a long way to ensuring something like this doesn't happen again.
You know, I think you touched on something, and I think the cryptocurrency, obviously I think that's a new frontier in so many ways, and I think it's important that we understand that. But it's interesting, I saw an ad for the Signature Bank. They had some pretty interesting ads. One of them had a musical number where the executives were saying, well, if this fails, we only have ourselves to blame, but apparently they weren't taking much of that blame. That being said, if you're going to be dealing in high-risk businesses, do you feel that there needs to be a different liquidity ratio for those banks?
Absolutely, and I think that's part of the examination process is to look at the type of business that a bank wants to do, assess the risk appetite of the executives and the board, and make sure that everything the bank is doing meets with that risk appetite. So if you want to take on riskier customers that might have a higher chance of flight or more uninsured deposits because that's what your business model dictates and your risk appetite, then you have to have liquidity and other risk management measures in place to make sure that you are able to handle that. As a regulator, we will not tell banks who to bank and who not to bank. Our job is to make sure the risk management practices in place match the bank's risk appetite.
Well, that absolutely. I think if you're going to say you're a non-traditional bank and we're going to deal with the folks that perhaps traditional banks won't deal with, but at the end of the day, you're a bank. You're not a hedge fund. You have to really adjust that liquidity. So would you say that, and I noticed in your report that you put a big focus on that liquidity issue, which
Yes.
you just discussed. You know, what could have Signature Bank done, in your opinion, to avoid that, specifically looking at the liquidity issue?
Yeah, I think Signature over a number of years, and it's highlighted in our reports of examination, did not have sufficient liquidity stress testing to account for its growth and its business model. So I think having that stress testing be more in line with the business model could have helped the bank. They also did not have a good handle on their data, as we said in the report, and I've said to my testimony, to the tune of, for example, when we asked for estimates of outflows, from Saturday to Sunday, we saw the bank's estimates of outflows quadruple from under $2 billion to almost $9 billion, and those were just known outflows, not the unknown outflows. Similarly, there was a basket of securities that they had that they persisted and insisted were going to be pledgeable to the Fed for liquidity. We got one estimate that those securities were worth $5.1 billion, and 35 minutes later, the bank revised that estimate down to just $900 million. So making sure they have a handle on their own numbers is incredibly important, and it's why we made one of the recommendations in our report was about operational stress testing for institutions and making sure that they could produce data quickly and accurately.
So with that being said, I can't imagine that they're entirely alone out there, although it does seem somewhat unique. Do you feel that more needs to be done to protect other financial institutions, or at least their depositors, based on what you saw at Signature Bank?
I think a lot of banks are dealing with the interest rate risk that's been created by the Fed's rapid increase in interest rates. I know there's been a lot of discussion about that, and that's something, to your point, Senator, that banks across the country are managing. And of course, with remote work and the valuations of commercial real estate, I think that's also something that banks across the country are grappling with, along with regulators, to make sure that they have the proper assets on their balance sheet, the proper liquidity and other risk management strategies in place to account for that.
Yeah, I mean, in the end, really, though, if you were in a more of a traditional risk area, you would think the increasing interest rates would likely mean people would put more money in the bank and not less, because it's. But that being said, I understand the dynamics of this. But I'll yield to my colleagues here. But I just want to say thank you again for being here, and we may have more questions after. Thanks.
Thank you, sir. Senator Bridgeport.
Thank you, Mr. Chair, and thank you, Superintendent, for your testimony. I want to circle back to some things you said about matters that you brought up in 2018 and 2019, or not you, but DFS, with Signature Bank that were left unresolved. Just clarifying that you did say that, right? There were
Yes.
matters brought up 5 years ago that were still left unresolved. Were those all related to liquidity, or others as well?
So there were matters related to liquidity that remained unresolved since 2018. There were other matters that were also old and unresolved, but depending on the matters, it's sort of a different time frame for their lack of resolution.
Could you speak more to any other matters aside from liquidity that were left unresolved?
I think liquidity is really the prime one. Some matters around corporate governance were still open at the time the bank failed in terms of the reporting structure, the clarity of decision-making, and other corporate governance issues as well.
Thank you. And in addition to this issue happening with Signature Bank, are there any other banks in New York you're aware of that have problems outstanding which have also been left unresolved for years?
So, of course, I won't name institutions in this context, given the confidential nature of our supervisory information, but we have, as a result of this and as part of the review that I have undertaken, both because of Signature and in general, when I came into DFS 20 months ago to modernize our supervision practices, gone back to look at exams of a number of our institutions to see where there are persistent issues year after year after year, to move to resolve those now much more quickly. And again, we are designing a new protocol for escalation so that staff knows that they have an ear in leadership to escalate issues and to move those matters either to enforcement or some other type of resolution more quickly.
And given these new protocols in place and that we have seen a few fairly large bank collapses this year, do you believe the staffing levels at DFS are adequate right now?
I do not. As you know, I'm so grateful to you and your colleagues for fully funding DFS for the first time in its history in the 2 budgets, I guess, now ago. In 2022, we hired 200 new staff. We promoted almost 200 of our existing team members, and I brought on the first new class of examiners since 2018. But we are still very short-staffed and could use more staff, and we are hiring as quickly as we can, especially given the pay differential between DFS and federal regulators.
And thinking back to the way this was handled by Signature Bank, in your opinion, did the board of directors at Signature Bank do a satisfactory job of managing the bank's risks?
I think the reports of examination over years really outlined a number of unresolved risks, from corporate governance to liquidity management to interest rate management. So I think there was certainly more that executives and the board could have and should have done.
In addition to the board members, the managers at
Yes.
Signature Bank? In your March 2023 testimony, you noted the regulators had downgraded Signature Bank to less than satisfactory rating and identified material weaknesses in Signature's contingency funding plan and liquidity stress testing, including unsupported critical assumptions. Could you just explain what does contingency funding plan mean and who's responsible for that?
Absolutely. So it is how the bank is going to satisfy its obligations, essentially in a moment of stress like the one we experienced. So does it have collateral it can pledge to the Fed in order to get cash to satisfy those obligations when depositors want to make withdrawals, for instance? And as I described in my testimony a few moments ago, things like if you have a basket of securities that you're valuing at over $5 billion, but 35 minutes later revising the valuation estimate down to $900 million, you do not have a viable liquidity or contingency funding strategy. Similarly, the bank had a number of assets on its balance sheet that it insisted the Fed should accept as collateral, even though the Fed had said over and over and over again it could not and would not accept that collateral, or it would take them weeks to evaluate it for whether or not it could be accepted, and yet the bank persisted that that collateral should be accepted in order for it to have the liquidity it needed.
Okay, and just two more questions, Mr. Chair. Thank you. So in a bit, we're going to hear from Mr. Barney Frank, a former director at Signature Bank. To your knowledge, was he at least partially responsible as a director for responding to any of these matters requiring board approvals?
I have tremendous respect for Congressman Frank. I mentioned to him earlier that I spent the majority of my career in the public and private sector implementing his very important law. I think there's more that the board, that the executives, and frankly that regulators could have done to prevent this from happening.
Okay. And just circling back to a question from the chair earlier about crypto. So I'm just looking at the FDIC, report on the management of Signature Bank, and in their executive summary on the very first page, they cite as one of the causes of failure that Signature Bank failed to understand the risk of its association with and reliance on crypto industry deposits, or its vulnerability to contagion from crypto industry turmoil that occurred in late 2022 and into 2023. Do you agree with the FDIC?
Yes, I do.
Okay. Thank you.
Thank you.
Thank you, sir. If I can encourage my colleagues to focus on the board, if you wish, and not on any individual member, I would appreciate it. Senator Tedesco, sir.
Thank you, Senator. You kind of touched on it already with the senator, with his question, but could you tell us about how many financial institutions there are to begin with in New York State, and from your determination, not the names of any of them, but about how many of them would you classify as being in risky territory?
Sure. I want to separate DFS-regulated depository institutions from the total number because, of course, many of the banking institutions that we have in the state are federally regulated and the exclusive purview of the federal regulators. We oversee just over 100 state-chartered banking institutions, I think almost 20 credit unions, about 16 or 17 GSIBs, which are globally systemic institutions. On the risk criteria that we've outlined in the wake of Signature, I would say there are about a dozen that we've identified as high risk. But again, those are institutions from which we require daily liquidity reporting, daily inflow, outflow calculation. We speak, again, regularly with the Federal Home Loan Bank to understand what people are drawing down in terms of credit. We speak regularly with the Fed to see what's been pledged to the traditional discount window and to the Fed's program that they've put in place since the bank failures. So I think even those banks that we have deemed to be higher risk, I feel as good as one can about their safety and soundness today.
Could you tell me what the federal government has done or assisted you and the organization, your group there, in terms of containing the collapse of Signature?
Absolutely. So in the weekend of the failure of SVB and Signature, again, regulators were working very well and closely together to determine our set of options. In the event that we had to take the last resort option of taking possession of the bank and appointing FDIC as receiver, it was important to make sure that the uninsured depositors would be covered. It's not an easy decision for federal regulators, but they voted, and I'm grateful that they did, to invoke the systemic risk exception, which requires a vote of the Federal Reserve Board of Governors, the Federal Deposit Insurance Corporation, the FDIC, the Treasury Secretary, and the approval of the President of the United States. And invoking the systemic risk exception at the time for SVB and Signature allowed the FDIC to provide coverage for uninsured depositors. That was important for Signature Bank because, as we know, the diversity of that deposit base included wholesale food vendors and small law firms and a number of other small businesses here in the city, and making sure that they would have their funds available to them when the bank opened on Monday under FDIC control so that they could make payroll, pay their bills, was extremely important. And so, I am grateful that the federal regulators took that action.
Thank you, Superintendent.
Thank you.
Thank you, sir. Senator Claire.
Thank you. Forgive me if I missed this because I did step in a little late, but I got a summary pretty much of DFS's things that they think they could do to prevent this in the future. And I just want to drill down on one particular bullet, two actually. One that talks about needing clearer internal guidelines about examiners' need to escalate regulatory concerns, and then it goes on to say it also needs guidelines for escalating instances when banks do not fix the problems regulators identify. If you could talk a little about that particular bullet, if there were problems that were identified, and then what are those fixes that, and how do we fix that from happening to prevent this in the future?
Yeah, absolutely. Thank you so much for the question, Senator. So Signature is a perfect example where liquidity risk management had been flagged in reports of examination going back to 2018. There are times in the past where DFS downgraded the bank for their inability or unwillingness to resolve those issues. But in hindsight, I think, and it's somebody who's been here now for 20 months, to say further downgrades may have been in order sooner, or should those issues have been referred to the enforcement division. And now we are in the process of designing protocols to say, for instance, if an issue persists for X number of years unremediated, right, here are the things you should consider to make it a downgrade or to refer it to enforcement. I think part of this, too, is not just the procedures on the page, but frankly, a culture that allows line staff to come to leadership with what they are seeing, because they are really the front lines. So it means supporting them with more staff, but giving them the freedom and creating the culture for them to raise their hand to identify these issues to leadership.
Yeah, 2018, I wasn't good at math, but it's 2023. How long would it take, I mean, for someone to be called on that?
Yeah, it's a hard question to speculate about or to answer in the hypothetical, but I think this is a question that frankly all regulators are grappling with. As you know, we examine our institutions, the state, many of our institutions jointly with the FDIC, so we do those examinations together, the reports of examination together. We come to those grades jointly as well. And it's, I think, an important topic of discussion that regulators are having across the board.
In the case of Signature, when they were first told, I guess that would be 2018, you have a problem. Did they come back with any kind of response, any kind of fix at all? What did they come back in 2019, 2020, 2021?
So, of course, I can only report on what I have read in the reports of examination because I was not in this seat at that time.
Right.
Each of those issues is a package of what we call supervisory recommendations. So underneath the umbrella of liquidity risk management, DFS would often outline 18, 19, 20 supervisory recommendations. Really think of them as steps the bank could take to remediate the broader issue of liquidity risk management. Often what we would see with Signature, if you go back and look through the reports, is they would remediate 2, 3, 4 of those supervisory recommendations underneath the umbrella, but not all of them. And then over the years, even if they were remediating some, new would appear such that the issue of liquidity risk management was never fully remediated.
Okay. And I also see here you have a bullet where you plan to work with stakeholders and others to develop some new regulatory tools and hold management accountable
Yes.
for misconduct.
Yes.
Where are we in that process?
Yes, I'm glad you asked, Senator. There is a bill now before the legislature that would enhance DFS's authority to remove bank leadership for misconduct. My understanding is it's been introduced in the Assembly. My hope is that it will also be introduced in the Senate and move forward. Right now, our tools, frankly, are pretty limited when it comes to the removal for misconduct by executives, so we would like to see that enhanced.
Thank you.
Thank you. Madam Superintendent, you spoke of the Federal Reserve and the interest rates. How much of a difficulty is that causing New York banks, the rapidly increasing interest rates?
Well, I think it's important to say that it's not causing sort of more difficulty or more challenges in New York than it is in the rest of the country. But of course, as part of any bank's capitalization strategy on their balance sheet, they will hold treasuries and other securities. So as interest rates go up, the value of those securities comes down, right? There's an inverse relationship there. And so it means the more interest rates go up, the less those things are worth. And so if you need to sell them to get cash to give to your depositors when they're seeking to make a withdrawal, you're probably taking a loss. So right now, banks across the country are sitting with their balance sheet having what we call unrealized losses on their balance sheet because they have not had to sell those securities. But in the event that a bank has to sell those securities, if, for instance, there is a run, they will do so likely at a loss and not have the cash on hand necessarily to meet the demands of their withdrawals. So it is a problem all over the country, but of course the Fed works very hard to think about the monetary policy side of the house and what it needs to do with interest rates to protect consumers from inflation and make sure the job market is functioning well. And the supervisory side of the house, and I don't want to speak for the Fed, of course, but I think they are really thinking about that division of labor and how maybe to better communicate on both sides of the Federal Reserve.
Let me probe you a little on two questions. The uninsured, who were they? I don't, of course, need names. I do need groups. And my second question has moral hazard disappeared in all of our thinking? But the first question, who were the uninsured at Signature Bank?
Yeah, I mean, they're largely small businesses, small or medium-sized businesses. So currently the insurance cap is $250,000 in a bank account. Anything over that is, of course, uninsured. But you often see small businesses with uninsured deposits because, frankly, it's not workable to have multiple deposits. Even, a small business with $1 million that it has in the bank to make payroll, to pay its lease, right, to pay vendors, it's frankly unworkable to ask them to have 4 or 5 bank accounts. And so often what we see with uninsured depositors, and again, I'm speaking for Signature, not Silicon Valley Bank, is that you have small businesses, the wholesale food vendor, the law firm, the title company, that would have uninsured deposits at a bank.
I know it's more of a philosophical question, the moral hazard question.
Yes.
I know it's not simply our domain in New York State, but are we going to go back to 250,000? Are we going someplace else?
Yeah, so I'll defer to my colleague who's here from the FDIC. I know they have proposed a rule, and they've proposed a rule on assessments to cover the damage to the deposit insurance fund from the bank failures, but they have also written a report about how to potentially modernize deposit insurance in the United States. So I will defer to my colleague to speak more to that if it's of interest to the panel.
We certainly will look into this question of the pay difference between the federal and state regulators. New York, of course, being the Empire State, has to have the best. So I look forward to, in a different place and different time, to return to that question of what does the state Senate need to do to make sure that DFS is the best agency that we can have. If my colleagues have no further questions.
Well, if I may, sir,
I was going to
on
allow
that. So on average, DFS will pay its staff 30 to 50% less than our federal counterparts. So while it might be expected that we would lose personnel to the private sector in the financial capital of the world, often what we see is we lose personnel to federal regulators. So they stay in the public sector, which is wonderful, but they make 30 to 50% more by going to a federal regulator, all of whom are based here in New York, not just in Washington, D.C. As you know, we are fully funded by assessments, not taxpayer dollars, so we assess industry to keep the lights on at DFS, but we net the state of New York about an average of $1 billion a year to the general fund in enforcement. Another example I'll give, last year, our Consumer Assistance Unit and our Enforcement Division were able to return over $154 million to New Yorkers directly to their pockets in the form of restitution. So if you imagine, to pick a round number, the average Consumer Assistance Unit worker making $100,000, and we have 60 of them, and those 60 people we're able to return almost $155 million directly to New Yorkers in restitution just in 2022, and we're on pace to beat it this year because I have been very focused on that accomplishment. But that's an investment we should be making many times over.
Yes. Is there any final statement that you would like to make, Madam?
No, I thank you for inviting me here today. I look forward to continuing to work with all of you. You were all such wonderful partners in the immediate aftermath of the bank. You were all very accessible and reachable, and I appreciate that. And I look forward to continuing to work with all of you as we look to prevent this in the future.
We look forward to working with you in the future. We take, as you know well, oversight seriously, and I trust this has not been very painful. Thank you very
sir.
much, Madam
Thank you.
Superintendent. And thank you to your staff, which also works well with us.
We need more of those people that take money back for us.
Who could, how do you, what do you do with that? Oh, Madame, I'm sorry, I didn't see. We will call our next witness. Would you be kind enough?
Congressman Barney Frank.
As he takes his seat, I want to thank him for coming from Massachusetts to Albany. I have been told that this is his first trip to Albany.
Yes.
And under those conditions, I'm sure that you will give him an Albany welcome. So I'm really grateful that you're here, sir. And let me take a point of privilege of saying that your Dodd-Frank, your position of in Dodd-Frank was one that we still study, and that we are learning. It was a mastery of not just the subject matter, but also of banking and of politics, getting it done. To know is one thing, but to get it done is quite the difference. Having said that, we will. We're going to start with you, sir. I think that you are the best person to speak on your issue.
Thank you. I want to start with a note of agreement with the superintendent. Her people are underpaid. Your staff is underpaid. The American people do not understand what a bargain they get because so many talented, dedicated, committed people enter public service for a lot less than they could make in the private sector. And yeah, I would second what she said, and I will throw in that one of the constraints we have on paying these people is, frankly, and I was a legislator for 40 years, I've told people my epitaph is going to be the gentleman's time has expired. And we don't pay ourselves enough, and then that becomes a cap on others. So either let's pay ourselves more, yourselves, or forget that as a cap, because you have people who are in the public sector dealing with people in the private sector who are paid a great deal more, and that isn't the only metric about getting good people, but we obstruct our own ability. Secondly, I'm going to have two parts. One, discussing the closure of Signature Bank, and secondly, what we do going forward. I first will address the question of my personal culpability. I may disappoint some people, but no mea culpas today. On other issues, yeah, I got plenty, but not today. On February 15th, as a member of the board of Signature Bank, I attended a meeting with the regulators from the FDC and the DFS. At no point in that meeting did any of them sound an alarm, did any of them say things are in serious difficulty, and quite to the contrary, in the CAMELS rating, which is the acronym for the quality rating given to banks, we got a 2 renewed. 2 is about as high as you can ever get, since 1 is perfection. So on February 15th, less than a month before the DFS asked the FDIC to shut us down, I was told as a board member that we continue to have the very high rating of a 2 that we had before. In fact, what transpired was that nobody, including the regulators, foresaw the incredible run on the bank that we had. So I don't feel guilty as a board member working part-time, although very well compensated, I will acknowledge, but working part-time, that I did not have more prescience than the regulators, who reassured me as a board member that we were still in the second highest rank and there was no deterioration. What then happened, of course, was significant deterioration, but not right away. And I think there's been some lack of clarity about crypto. It is acknowledged that Signature's dealings with crypto were safe and sound. We did not have crypto accounts. What we had was, it was a very, I thought, thoughtful idea. The heads of the bank say, well, crypto is coming. I will tell you personally, I wish there was never such a thing. I wish Sissoko, whatever his name was, had never invented it. But it's here and we got to deal with it. And you're a bank, you're in the business of facilitating commercial transactions. That's not just the way you make money, it's your social function. What the leadership of Signature said was, okay, to the extent that there is going to be a migration from one form of currency to another, crypto, our job is to facilitate that. So what we did, we didn't invest in crypto, we didn't take crypto deposits. What we said was, if you're a depositor of our bank and another depositor in our bank, if you two voluntarily decide to deal with each other in crypto, we'll be the platform for that. We don't take any of the risk. And I think, frankly, if there's going to be crypto, it is a responsibility of a bank to do that. What then happened was, as the superintendent acknowledges, I'm not good with this. I'm afraid, I'm afraid I'm going to outlive two of the things that I've always relied on, newspapers and my spine. But what I do have here is this quote from the official report. While the role of, this is from the DFS report, while the role of digital assets in Signature's failure has been the subject of speculation, the percentage was relatively proportional. So in other words, it wasn't that people who were in the digital business themselves panicked. It was other people who didn't understand the business but were frightened by it. And here's the key sentence. The bigger issue for Signature was that the bank had a high concentration of uninsured deposits and was perceived as a crypto bank. In that sense, it was closely associated with Silvergate and SVB. So I wasn't clear, frankly, what the superintendent was saying. No, she's not hostile to crypto. We weren't hostile to crypto. Unfortunately, a lot of uninsured depositors were hostile to crypto and made the mistaken guilt by association of us and Silicon Valley. By the way, I read about Silicon Valley. They are charged with the regulators for doing some things they shouldn't have done. And one of the things that happened to them was this devaluation that you've all referred to of the high interest rates, devaluing their treasuries. We weren't in that position. You know, I should note, by the way, on the day we were shut down, I believe prematurely, our assets were fine, our capital was fine, our loan portfolio was fine. The only problem we had was crypto fear, inaccurate withdrawals. So, and we were very unlike Silicon Valley. So yes, I guess all of us, including the people who gave us a 2 less than a month before we failed, none of us anticipated the degree of irrationality that drove people to withdraw their deposits from our bank because they confused us with Silicon Valley based on that emotion. And now, yes, apparently, we had not done enough to deal with the liquidity crisis of that dimension. I have to say, by the way, even if we had done a stress test, I don't think it would have changed much, because if anybody had fed into the conditions of a stress test the degree of public hysteria over the possibility of crypto, I mean, you would have had to put into the stress test FTX and that scam, and then the consequent failure of Silvergate and Silicon Valley. I don't think any stress test would have done that. It would have been dismissed as extreme. So then the question is, okay, but nonetheless it happened. What about the inability of Signature to prove to the regulators on Sunday that we had enough assets, we had enough collateral to get the assets to meet the deposits? Well, first of all, let's look at the time frame. Everybody acknowledges the flood of withdrawals began Friday afternoon. So we're talking about a period of about 48 hours, in fact, less, because it was Saturday when they decided we had a 5, Saturday night. Yeah, things were confused. People who were working to try and come up with those numbers over the weekend, it was a problem. The FDIC notes, by the way, that two of the problems were that the Federal Home Loan Bank and the Fedwire both closed, and that we were too late before they closed on the weekend. Well, part of the problem was, yeah, they closed on the weekend, but the turbocharging of deposit shifting didn't close. You know, there's no more run on the bank. It used to be a literal physical run on the bank. Now there's a push button on the bank. Push 2 buttons, out and in. So, yeah, I understand that there was a problem. The fact that there was confusion about the numbers, I understand that raised questions. But let's be clear what neither regulatory agency has contested, to my judgment. Our assets, our capital, our loan portfolio were all fine. We were not in the position where we had bad loans. It was not a case of the toxicity you'd seen before. The problem was that we had been, I believe, a well-run bank, got a 2 a few weeks before, and then there was an unprecedented, unpredictable, panic-driven mass withdrawals. And yet we weren't fully prepared for that, and yes, we had been told we should have done more. By the way, I looked at the MRAs, et cetera. More of them, well, a large number of them had nothing to do with our soundness. That is, they didn't go to the assets or to the capital. A lot were in money laundering and that issue, which are problems, but don't go to the soundness. There was a liquidity issue, and we did not have that resolved to the point that we should have. What I believe, though, is that on the Sunday, given that this had come up so suddenly, and that we were a solvent bank, let's be very clear, no one has denied that we were solvent. The problem was this, we weren't ready for all the runs. And by the way, when we did the financial reform bill in 2010, we anticipated that and told the Federal Reserve System that they should be ready to set up a facility that dealt with banks that were illiquid but solvent, through no fault of their own. Senator, you asked, well, what happened in New York? Well, I think you asked that. The answer is nothing happened in New York. Silicon Valley and Silvergate and FTX happened, and they affected New York because of the depositors. So my criticism of the regulators is when they didn't warn me, when they should have. They reassured me it was imprudent. They said it wasn't prudent. That it would have been more prudent to have downgraded us. They didn't. But beyond that, I think they should have waited a day or two. The amount of money, the amount we could have lost, we were solvent. And I'll give a criticism of the Fed. I've generally been supportive. I'm astounded to learn that the Federal Reserve, which can pay people more, which has a very high level of employees, unlike the federal pay scale, that it was going to take them, quote, several weeks to analyze some of our holdings. I worked with the Fed in 2008 and 9. Wow, they dealt with hundreds of billions of dollars in about a half hour. The notion that it was going to take them several weeks to sort out some of these holdings. I'm not talking about the foreign part. I'm talking about it was going to take them several weeks. If they had been told, look, we got to get this done, high priority, I think there was a chance it could have saved, that if we'd opened, we would have worked. And here's the other thing that's frustrating, and maybe it's partly my fault, that we did say that the Fed, in lending money to institutions that were solvent but illiquid, had to have several. And that, some people suggested, and I think it's plausible, that that's why we got shut down. Silicon Valley was shut down. But under the law, and maybe we should go back and look at this, I helped design it, they could not set up this facility unless there was more than one bank. And Signature, whether that was a motivation or not, the failure of Signature was necessary to give the Fed the predicate for creating this. And here's the irony. Once Signature was shut down by the regulators, and the Fed then announced, or the FDIC then announced, it would hold the depositors harmless, it cost us some money. Had they been able to make that declaration that they were going to hold the depositors harmless before it was shut down, we would have been fine. Now, I think that's one of the things I want to look at. Last point, talking about the future. First of all, we got to regulate crypto because it is the volatility and the uncertainty about crypto. And the Feds and the, again, I wish it wasn't around, but I wish a lot of things. I wish I could eat more and not gain weight. The point is that it's here, and it is the uncertainty because of the regulatory ambiguity about crypto that was the basis for this. When people couldn't tell the difference between FTX and Silicon Valley and a bank that said, give us dollars and we'll process your crypto accounts. Three very different things. The other thing is we've got to deal with the deposit insurance situation. I don't believe anything could have, given that panic that we had, again, I don't think any stress test would have, nobody predicted it, the regulators didn't, we didn't. So now I think what we need to do, and if I can take one and a half more minutes, Senator, I think what we should do, what the FDIC, what Sheila Bair, who was one of the best regulators we ever had, who ran the FDIC, and it's something we tried to do in our version of Dodd-Frank, and we lost out to, I think, an invalid argument, which I'll get to. What we have to do is to say that if you are a small business of the sort that the superintendent accurately described, if you can show what you need to run the business for 2 months in terms of payroll and vendors and other necessities, that you can get insurance for that deposit enough to get you through 2 months, which then gives you time to go elsewhere. Now, the argument against that, I'm told, is, oh no, that's a moral hazard because the fact that depositors are worried that the bank might fail, it puts pressure on the banks to be better. So in other words, we put the depositors at risk. We put small businessmen at risk who, without question, need more than $250,000. By the way, we wanted to go beyond that, and we went from 100 to 250. The Senate wouldn't go along with us. Not that House Senate frictions are ever anything that you guys have to deal with, but the argument is, well, depositors will become a force for safety and soundness, because if a bank isn't being well run, the depositors will be afraid of losing their uninsured portion. In other words, you're a small businessman, you're trying to run your business, but you're also supposed to be a bank examiner. And in fact, you should have known better than the FDIC and the DFS did, because they didn't see it coming. I'm reminded with that, there was a great story in 1964, Khrushchev was overthrown. And somebody said to the head of the CIA at the time, I guess you guys don't have great sources in the Kremlin. He said, what do you mean? He said, well, Khrushchev was just overthrown and you didn't see it coming. He said, you know what? Khrushchev has great sources in the Kremlin. He didn't see it either. I think so it's an impossible position to put a small business person in. And by the way, not only is it hard if you're a small business person to monitor a bank, it's illegal in some ways. The kind of information that the superintendent talked about, that the FDIC talks about, that you need to monitor a bank, it's illegal for that to be given to a private citizen. Let me just read you a page from Ben Bernanke's new book.
You're not advertising it, sir.
No, he doesn't need this. Dodd-Frank also required the Fed to disclose information on discount window borrowers with a 2-year lag and borrowers from 13(3) programs to help the insolvent, within a year of the termination. In other words, what we said was, okay, you don't have to tell them that same day, but 2 years after they've gone to the discount window, 1 year after they've borrowed from that pool, you have to make it public. He said that's a bad idea because these tougher reporting requirements will increase the stigma of borrowing from the Fed. And there were other laws. It's illegal to disclose information, for me as a director, to disclose some of the information. They told, when I said I was going to mention this retention of the truth, people said, well, that's illegal. Well, it wasn't because we were closed. So the notion that a small business person could be an effective monitor of the safety and soundness of a bank when it is in fact illegal for her to get much of the information you want is a great mistake. So clearly going forward, the answer is to insure transaction accounts. And one last point, if I may. And it is, I don't know what we were supposed to do. I've read this. I'm reminded, again, I like to tell stories. There was a softball game where Groucho Marx was the manager and Jack Benny was playing. And Groucho Marx said to Jack Benny, go hit a home run. And Jack Benny hit a little pop-up and was out. And Groucho Marx said, well, I quit. This team doesn't follow instructions. I've read the reports. I haven't seen, what should I have done that I didn't do? Yes, solve the liquidity problem. But how? There's no decision there that they was wrong, except from the FDIC, and this is a serious problem, and I'm going to urge you to do some further looking into it. I joined Signature in part because they had a great record in housing. Signature Bank, until its closure, was one of the biggest users of the low-income housing tax credit to build affordable housing in the country. And I felt strongly about that because I collaborated with a former member of the New York State Assembly named Charlie Rangel, when he was chairman of the Ways and Means Committee, to create that program and to support it. And that means lending to people who are going to build affordable housing. And from the day I got on the bank, I was troubled by the FDIC telling us we were doing too much for affordable housing, that was too risky. And they say in there, well, they're critical, we expanded too fast, and we went into new businesses. We went into helping various other types of business. Well, one of the incentives we were given was by the FDIC, which said we had too large a percentage of our business in affordable housing, residential, commercial, real estate. So we had two choices, either get into new lines of business or cut back on affordable housing. I can't think of a more contradictory policies. And by the way, I've asked and looked, commercial real estate people are worried about, but residential commercial real estate has held up better than anything else. It holds up better than office buildings because you can work from home, but you can't live at the office. So homes have a better retention rate. So I would urge you to look at this impact of telling banks not to do affordable housing, multifamily housing, which the FDIC has been pursuing. They told us the percentage of our business that was in commercial real estate was too high. There were two ways you deal with that. Either you cut back on your affordable housing lending or you go into other businesses. But the single biggest thing to do is to provide transaction insurance, as we call it, for small businesses that need more than $250,000 for a 2-month period to run their banks. Thank you.
Thank you, sir. I have several questions, but I'm going to ask but one, and then I'm going to yield to Senator Tedesco if he wishes. I will return to my questions after my colleagues, but my question is simply this, sir. What percentage of the blame for the failure of Signature Bank would you give to management? What percentage?
A very small percentage. I would give a percentage of maybe in the 20%, and I would divide it up among management, the regulators who told me on February 15th that we were about. Most of the blame goes to the people who irrationally withdrew their deposits. Our part of the blame is, and by the way, they say in the reports, we did not fully comply with the liquidity recommendations, and we should have. But we were getting better. They said there was some remediation going on. I don't think, even if there had been stress tests, people would have anticipated that degree of withdrawal. I'll take it back. There is one other thing. I think, and I was not aware of this, I read the report. We apparently did not do a good job. The management did not do a good enough job of vetting our potential collateral for the Fed. And I agree that that was a mistake.
Explain that just a little bit more.
Well, remember, they said that there were two reasons why we had enough collateral. I would tell you this.
Okay.
If you wait a few weeks and count up the collateral, it's more than what we would have needed. But the Fed said they couldn't process it quickly for two reasons. One was going to take them several weeks to go through various loan portfolios. I do not understand that. That's ridiculous. They also said, though, that some of what we offered were loans that had a foreign participant. And apparently we and this may have been my mistake as a legislator, that we did not allow them to have an international component. So we should have more clearly segregated some of that collateral to have been purely domestic.
Thank you, sir. Senator Tedesco.
Thank you, Congressman, for that testimony. Appreciate it. I believe when I was listening to the Superintendent Harris, she mentioned that these deficiencies at Signature dated back to 2018. And were you aware of that? Was the board aware of that in 2018? And was it a case
yeah,
that...
we were aware that there were issues they wanted us to work on. We worked on some. Some got better. I mean, they all got better, not at a rapid enough pace.
Not enough
But-
mitigation of that? Up to
Well, yes, sufficient for the time. Before we had this kind of, in the absence of this unprecedented, unexpected bank run, we were okay. Again, I want to go back to, you said 2018 correctly, but in February of 2023, they reaffirmed that we were a 2 in the Camel rating. That is as good as a practical matter as a bank gets. So yes, I was aware that they had things they wanted us to do better, but I was reassured by them that they were not threatening to the safety and soundness existence of the bank.
So was this an anomaly that this happened to this bank?
Yeah, the anomaly is that you had a panic over crypto. I mean, that's, as the superintendent admits, everything is going fine until FTX, that terrible fraud. And then that leads to concern about whether or not crypto is sound and reliable, and you get Silvergate closing itself down, and then you get Silicon Valley being shut down. They had problems other than crypto. And then that leads to, on a Friday, this incredible, unprecedented outflow. Now, part of it, by the way, is technology. You know, where is Jimmy Stewart when we needed him to deal with a bank run? There used to be literally physically a bank run. You went down to the bank. Now it's out, in. It's 2 buttons. So, but the anomaly was this sequence of failure, of corruption and failures of crypto. And everybody acknowledges, the superintendent says, that's what caused our problem. I do think we should have been given more time to try and deal with it, and I disagree that there was anything that we really could have done beforehand to prevent that. I will acknowledge, apparently, we should have done a better job of vetting our collateral. But yeah, that's why I think dealing with the turbocharging of deposit shifting is a remedy that will work.
Thank you.
Thank you, sir. Senator Bridgeport.
Thank you, Congressman. I appreciate you taking the time to talk to us today. I'm curious just how you came to be on the board of directors for Signature Bank in the first place. Did you approach them? Did they approach you?
They approached me in, I think it was 2015. I was asked, they had a practice of having political people on the board. I replaced a guy who I think been Lieutenant Governor, Al DiBello. And when I joined the board, I joined former Senator Al D'Amato. And understandably, they thought it was good to have somebody who understood politics. They've always had a very diverse board. I looked into it, and one of the two issues on which I worked the hardest for most of my congressional career was affordable housing. And I learned what I just said, that they were the leading user of the affordable housing tax credit in New York, certainly, and I think in the country, and they were very active in the housing field. And so I was very happy, and it paid well. I had retired. I didn't have a pension, by the way. I, for various reasons, decided I'd stay out of the pension system. I didn't want to be a lobbyist. I don't condemn people who are lobbyists, but to be honest, maybe it's a little arrogance. I didn't want to go back to the people whose chairman I had been and approach them as a supplicant. I didn't want to have to go ask my former committee members for favors, but I wanted to make a living. And so I looked at what it would pay, and I decided it was a very good thing. Now, some people say, well, wait a minute, you were for bank regulation. How can you go on the board of a bank? And I will quote Sheila Bair, who I just mentioned as, I think, the best regulator. She went on the board after she left the FDIC of Santander. And she was asked, well, how can you go on a board of a bank when you were a tough regulator? And she said, well, what are you saying, that nobody who believes in regulation should be on a bank board? And in fact, I went on the board to support the affordable housing mission and to be supportive of regulation.
Thank you. I want to talk about...
By the way, I was about to leave my term. If there was still a board, I wouldn't be on it, because under the rules that apply in general, it's not a law, but it's a general practice, you don't get nominated to serve a new term on a board if you're over 80, unless your name is Warren Buffett.
Interesting. Pull the mic a little closer, sir. You were saying.
Yes, I want to ask about the housing before a few other things. I'm looking at an article from Vice that shows tenant advocates criticizing Signature Bank's lending practices for years, alleging that that Signature Bank lends to corporate landlords that have been among the state's worst evictors and whose risky businesses model destabilizing.
When was that article?
It's a Vice article.
When?
When? Don't think I have the date. I think it is from March of this year.
When I went on the board, there was a conflict with a particular housing advocacy group. I forget the initials right now. And I insisted that we meet with them, and the chairman of the board and I met with them, and we adopted a policy where if there was any documented case of landlords not living up to their responsibilities, we would not make any further loans to them. And I did not hear complaints from the advocacy groups, the one that we originally met with, and we followed that policy. If there were any, as I said, documented complaints of abusive landlords, we cut them off. And I know of landlords we cut off. So I don't know who was making the allegation. I do know the largest group that we dealt with, that I went to meetings with early on, we worked out a deal with them. They were satisfied.
And in addition to asking the advocates for documented complaints, were there any actions taken by Signature Bank, audits of the landlords that were lent to?
Speaking on them, I don't hear too good.
Louder.
Oh, sorry. Can you hear me better now?
Yeah.
So let me just pull it closer. Here we go. So in addition to asking the advocates for any documented information, were there any actions taken by Signature Bank to audit or check in on the landlords?
No, we didn't have the workforce to do the audits. Plus, from my experience, I think the best source of that are the people who live there. And we were very open. We had a department that was open for these complaints. And if we got complaints, we immediately looked into it. but we had a very vast, I mean, it began because we were such a large lender in affordable housing. We didn't, it would not have been practical to have a large staff of inspectors. We did, first of all, we were very open to getting any reports from the New York City, where we did most of our lending, regulators. And we then, so it was reports from them and any complaints we got from the tenants. In my experience, tenants will complain when they are being mistreated.
Okay, I want to let that go, and I want to just, I'm still not clear on the reasoning around this February 15th meeting and the sense that things were fine. Just thinking back to these matters requiring board of approval that date back to 2018, 2019, just how is it that these could still be outstanding for years?
Oh, I don't think any were outstanding that whole time. We would make progress in them. And these are complicated matters sometimes, but in every case, I think there was improvement, and it wasn't getting worse. I don't think any bank has 100% immediate remediation of everything, and there were new ones. They'd be on the same subject. You would have one, and then there would be more developments. But I am not aware of any complaint in 2018 that was relevant to the shutdown. You have to tell me what they are. What are they? What are the? I mean, what were the specifics of these?
I think that's a question for the regulators. I'm hearing that they're mostly around liquidity, but I am just curious. When the regulators downgraded Signature Bank to a less than satisfactory rating, did that signal anything to you?
No, we got a satisfactory rating on February 15th. Maybe you missed my point.
When was Signature Bank downgraded?
The Saturday before it was closed on Sunday.
Gotcha.
Which seems to be a little late. The February 15th, when I met with them, both sets of regulators were there, they reaffirmed our 2. They did say they were worried about liquidity, but 3, not disaster. And on February 15th, 2023, they reaffirmed a satisfactory rating, or 2,
Okay.
which is as high as it had been, and it continued to be.
And just, I have another question about timeline. So, in a report from DFS on Signature, they said on March 2nd of this year, the bank requested and received a 15-day extension to respond to their supervisory letter. And that the March 22nd request was a little more than a week before the bank collapsed.
Yeah.
So why did Signature Bank request more time to respond to the
Because these
supervisory
are
letter?
complicated issues. Maybe you get everything done before any deadline, Senator. Most people don't always do that. These are complicated questions. Extensions, that meant we were working on it. It may have meant in that particular case it was more complicated than people had thought and wasn't as easily done. You know, I just go back to when the Federal Reserve said it would take several weeks to sort out a fairly simple question. So I don't think the fact that there was a 2-week extension is at all relevant to the collapse.
Sure, but if I could just finish my question. My question was, why did you request more time to respond on that
I don't know
date?
the specific any more than, well, what was the issue? Do you know what the issue was?
Restate your
I mean, Senator, do you think that I recall every single piece of paper that went through? If you tell me the issue on which we asked an extension, I might be able to explain it to you. But I will confess, even before my mind, I started losing memory. I would not have remembered everything that happened several months ago, every piece of paper that went through.
So do you not remember what the supervisory letter from
On March
DFS was?
22nd? No, I don't remember what I was doing on March 22nd or March 5th. I don't remember what I had for dinner. And the point is this, there were many letters. It wasn't just one letter. There was a lot. There was a constant back and forth. But if you tell me the issue, I don't think it was one relevant to the closure. I don't believe it was liquidity, but I couldn't tell you that specific piece of paper without knowing the subject matter.
Okay. And my last question is there anything you would have done differently?
Is there anything what?
You would have done differently?
Yeah. I would, well, one, I think going back to 2010, I would have made it easier for the Fed to respond, but I think the one issue was when they said that the collateral we offered over that weekend didn't fully meet the Fed standards. And yes, I think we should have done a better job. We had enough collateral. We were sound. I mean, these are procedural issues, but they become important. We were solvent. We were not in trouble. We hadn't lost money. But to get the assistance from the Fed that we needed to meet that outflow from the panicked withdrawals, apparently we had not met the Fed standards of exactly what shape it should be in. I don't have any question, it was enough, but it was not in the proper form. So knowing this now, I would say, hey, you better be sure that your collateral is in the perfect situation. But otherwise, when the FDIC said we shouldn't have gone into other businesses, well, if we didn't go into other businesses to satisfy the FDIC, we would have had to cut back on housing loans. No, I would not have wanted to do that. I can't think of anything else that we were asked to do that we didn't do, but I would have done a better job of making sure that the collateral we would be offering the Fed met the Fed's very specific standards.
Thank you.
Thank you, sir. We have been joined by Assemblymember Khalil Anderson, who chairs the Assembly Subcommittee, a banking subcommittee on the underbanked communities. And of course, we have been joined by Senator Cordell Clare, who will ask the next question if she wishes.
Yes, thank you so much. Thank you, Congressman. Sorry about that. I read in a summary that 30% of the deposits came from the cryptocurrency sector, and that was pointed to as one of the main problems. I think you even said that yourself. At what point did that become a problem?
I think they also say in the report that I think it became a problem at FTX. I mean, FTX was the bombshell there. And
Forgive me, I don't know all the acronyms.
oh, FTX was that scam run by a guy named Sam Bankman-Fried.
Okay.
Where
FTX.
he had magic money there that was, yeah. But when that scandal hit and people began to lose money because of it, and at that point, as the reports both say, Signature began to reduce its crypto-related deposits. Being very clear, they were never crypto deposits. They were deposits in dollars from people who were doing crypto business with each other. And we cut back on that and reduced that percentage because once the scandal with FTX started, people began to worry about this panic set of withdrawals. So that was about the time.
When do you think that became a problem? Like, when did
Yeah, I
that?
don't know the exact date.
No, not date, but was that 2023?
Either late 22 or early 23. I think early 23, but I think it was late 22.
Okay. And also in some of the background, in the brief, I was given a little brief history of Signature Bank. It said its goal was to service primarily wealthy clients. It says the goal of the bank when it was founded was to service primarily wealthy clients.
By definition, people who have more than $250,000 in the bank are wealthy. So most uninsured deposits, well, they're from businesses more than individuals.
That's what I thought I heard earlier, small businesses.
Well, yeah, medium-sized, I mean, not Fortune 500 corporations, real estate developers, people who, commercial real estate developers was the biggest single category.
And these are people that you had said earlier got most of their money through using the low-income tax.
They used the low-income housing tax credit to build. Not only that, there were some people who built market-rate housing too, which is also important. I think we need more housing in general. And then also, actually, it was not me, but the superintendent who mentioned other small businesses. She's the one who used that phrase, including non-housing businesses as well. It was sort of the middle market, it's called.
Okay. Now, you clarified a little bit on the collateral that was identified. Now, it sounded to me like the superintendent was saying that you did not present a certain type of collateral.
To meet the Federal Reserve standards, there were two problems, she said, and I read the report. One was some of it included some foreign investors, and apparently we told the Federal Reserve they could only accept domestic. The other was, and this one surprised me, some of it was packages of loans, which you can sell, and we thought they all held up pretty well. And that's the one where the reports say the Federal Reserve System, the Federal Reserve Bank of New York, said that it would take them several weeks to see if those were valid. And that just depresses me, that this great Fed would take several weeks to sort out packages of loans. Those were the two collateral issues that that the reports mentioned, to my recall.
So, based on what I've heard here today in the testimony given, you say the bank was sound. You say it had the money.
Nobody doubts that. Nobody doubts that we were solvent, or that the assets were good. When they downgraded liquidity, they didn't downgrade capital or assets, the two of the other relevant ones. And there was no question that we were making money. We weren't like Silicon Valley, where Silicon Valley had a problem because they had so many treasuries that became devalued when interest rates went up. That was not our problem.
And all the MRBA's matters requiring board attention, I'm just saying that because for people who, I didn't even what that, I had to look that up myself. All the MRBA's, you don't think had anything to do with
No, I don't think any of them led to the collapse. A lot of them had nothing to do with safety and soundness, and we were working on all of them. In fact, even on liquidity, which is the only one that is relevant to the failure, the reports say we were getting better, we weren't getting better quick enough. But again, on February 15th, they were not a threat to the bank.
So I got to ask you, why did the bank fail? I know
because
mentioned-
people panicked over crypto, and because of technology. One, because people panicked, and two, and this is one of the things that has to require change in deposit insurance, because shifting your deposits now is a free thing. Here's the deal. It used to be that shifting your deposits required some effort. Now you can do it by pushing two buttons. And if you go to JP Morgan Chase or Bank of America, you don't lose anything, so why not? But the reports say that. It was entirely because we were not able to fund the run on deposits that was generated to a great extent by fear of crypto, not by crypto itself, but by fear of crypto. And they, as the superintendent's report says, we were associated with Silvergate and Silicon Valley as a crypto bank. And people decided they better pull their money out of a crypto bank, even though it was an entirely different factual situation.
Thank you.
Thank you. We, of course, Assembly Member Anderson.
Yep. Thank you, Mr. Chair, and thank you, Congressman Frank, for being here this afternoon. So I have two quick questions. The first one was, and I'm not sure if my colleagues had asked the like already, so I'll ask you to repeat it if it's already been asked. But how do you know what investments the bank, specifically individuals who invested in the bank, where those investments were? What type of portfolios? Unions?
Oh, you mean the
crypto?
depositors?
Yeah, depositors, excuse me. Yeah.
There were a wide range. A large number were commercial real estate developers, because we were very big in housing and in commercial real estate.
Yeah. Did you have clients that invested in any union stocks or in any union reps representing in stocks?
Union?
Organized labor?
I don't know.
So you're not sure if there was any retirement accounts or any union dollars?
I am not aware of any. We did. Another category, by the way, we were a major lender to the theater industry.
Okay.
Another one of our concentrations was in the theater industry around Broadway.
Okay.
I do not know about retirement accounts.
Okay, so just to be clear though, you said commercial real estate, you said theater, you're not aware of any investments as it relates to retirement accounts?
I'm not aware of one way or
Okay.
the other.
Okay, no, just wanted to be clear.
I did not monitor that.
And that's not something you do in your capacity as chair of the board? When your capacity of being on the board?
No, I mean, we wouldn't.
Okay, no, just wanted to be clear. All right, so my next question was, you mentioned with my colleague.
By the way, let me go back. Retirement accounts, pensions, you wouldn't put them the interest rate would be too low. They would be looking for higher returns. I don't think you would be depositing retirement accounts in a bank and getting, less than 1% interest. They had to be looking for higher returns.
Okay, so you're not aware of it. Okay, no problem. Just want to clarify. And then the next question I had, and thank you, Congressman. The next question I had was compliance with the CRA. If your primary clientele were wealthier, as you had mentioned
We got a
in your
two.
testimony,
We got the second highest rating under CRA.
what were some of the initiatives that kept you guys in compliance with CRA?
Well, one was some contributions to, well, first of all, from the CRA, it's, remember, geographically based, and a very large amount of our lending were in CRA-eligible areas. When you're doing affordable housing, you're in CRA areas. And then we had some charitable donations. There was one project in Connecticut, working with young people.
And those were the things you said kept you guys in compliance with the CRA, both. Those are the things
The big
that you,
thing about CRA was community reinvestment. You do things in the
No, I'm fully aware of what it is.
All
I'm
right,
just
well-
asking what your institution.
housing.
Housing.
I said that.
Okay.
Because when you're doing affordable housing, you're in CRA-eligible areas, and our overall rating with CRA was a 2.
All right. Those are my two questions. Thank you, Congressman.
Thank you, Assembly Member. Congressman, I see you survived this one.
Survived a lot worse than that.
I'm sure we were trying to give you an Albany welcome. Is there any closing statement that you would like to make, sir?
Yeah, just again, I would urge you, and I was frustrated, I even raised this with the head of the FDIC, Mr. Grunberg, back in the Obama administration. I am very discouraged by the FDIC's negative influence on housing lending. And I would urge you to look at that as it affects New York. And in particular, I believe, and I've asked about this, I believe the statistics will show that lending, commercial real estate lending for housing holds up a lot better than most other lending categories. And there is an unfair restriction or an inaccurate restriction that the FDIC puts on. We were told at one point that 600% of our loans, we had twice as much housing lending as we're supposed to. And I would urge you to look at that and appeal to your federal representatives, who are fairly influential, to tell the FDIC to stop obstructing housing lending. The other is there needs to be deposit insurance reform. The notion that reassuring medium-sized business people that their deposits that they need to run their businesses will lead to reckless bank practices is just ridiculous. I talked to a lot of small business people. None of them feel that they have the authority, the resources, the expertise to monitor bank practices. What we do in Massachusetts, we have, well, I'm not there anymore, but Massachusetts has a state supplemental deposit insurance, and I would look at that if I were you. You could run a state supplemental insurance if you wanted to, limited to transaction accounts. So those would be my, well, one other one, and again, it's in Bernanke's. It's a problem, it sounds jargon, but we ran into a problem under, in 2000, before the financial crisis of 2008. Some people argue that the way to deal with the housing bubble, the illegitimate housing loans that were causing trouble, the subprime predatory mortgages, that the way to do that was to shut down interest rates in general. And you get a conflict in jargon between macroeconomic policy by the Federal Reserve, trying to stimulate or regulate the whole economy, and what the ugly word macroprudential, which is trying to regulate the system for stability. And there was, clearly, this became a conflict. The Fed raised interest rates for macroeconomic reasons, and it had a negative effect on the stability. And Bernanke mentions in the book that that's got to be worked out. Again, that's at the federal issue, at the federal level. But there has to be a better mesh between those, and at the very least, a recognition that if there are going to be major interest rate swings one way or the other that are going to affect the stability of banks, at that point, maybe emergency powers have to go to the bank regulators to try and cope with that.
In the days to come, I'm sure books will be written about the interest rate and the FDIC policies, but as worthy as it is, that's not our domain right now.
No, I understand that.
Although I take to heart what you said about those two, the housing lending question and the state supplemental insurance
Yeah, I think that
method.
you can do. You know, the feds control whether or not it's a federal statutory issue.
Very interesting.
But I do think, if I were you, I would be looking into the effect on the housing supply in New York, especially affordable housing, of the FDIC's negative view about commercial real estate lending, in particular housing.
We don't have a choice but to look into it, sir. New York State as a whole, and New York City in particular, undergoing an incredible affordable
When I
housing
raised it
problem.
with them, they said, oh, no, we don't want people lending too much to residential real estate, because what if rents start going way down and it collapses? I said, if rents start going way down in New York, let's all have a dance. Wouldn't that be wonderful? I would not regard rents, substantial reduction of rents in New York, either as likely or as a bad thing if it happened.
Well, I'm sure that we will hear from the FDIC, and they will
Oh, that's
opine on that when they're coming up next. Sir, I really appreciate your coming in here.
Thank you.
Thank you very much. I'm sure that Mr. Holland will make sure that all arrangements are made for your well-being. And thank you very much, sir.
Can I get a cup, Sam?
Paul, would you be kind enough to call the next panel?
Marshall Gentry and Dr. Larry Harris.
Assembly member, you could come a little closer. I don't bite that hard. I do, but.
A 50-50 chance.
see you from this position, sir. It's an interesting one. I didn't saw you before you put your tie on. Ties change everything, I always say. And good to see you too, Mr. Gentry. It's good to be here. Anyone who wants water, your best bet is to get it now. And let's see, since the FDIC was spoken about, we'll hear from you guys first, followed by Dr. Harris, of course.
Okay, thank you. Is this on? Yep. Thank you, Senator. I'm Marshall Gentry. I'm the FDIC's Chief Risk Officer. My office is sometimes called in by FDIC senior leaders to perform quick, independent internal reviews.
Little closer. Little closer.
Oh, yes, sir. Of various operational areas. We're part of the FDIC, but separate from the Risk Management Supervision Division, so we have a degree of organizational separation. I have an audit and risk management background. For most of my federal career, I was an auditor, first with GAO, and then with the FDIC Office of Inspector General. I became the Chief Risk Officer about 5 years ago. I don't have an examination background. However, during the 2008 financial crisis, I led 10 or so reviews of large failures, including ones of Washington Mutual and the FDIC's supervisory monitoring of IndyMac Bank. We thought a material loss review approach was a logical model to use for performing the work of Signature Bank. MLRs have two objectives: one, to determine the cause of failure, and then second, to evaluate the agency's supervision. We had a limited time to perform the review, about a month, and MLRs usually take about 6 months. I had an excellent team of 5 staff that helped out, and we also coordinated with the New York Department of Financial Services on the review, which was very helpful. With that, I'm happy to provide a summary of our results. New York State Department of Financial Services closed Signature Bank on March the 12th and appointed FDIC receiver. Signature was the 29th largest bank in the country and the 3rd largest bank at that time to fail in U.S. history. FDIC estimated the cost of Signature's failure to be $2.5 billion. Signature began operations in 2001. Starting in 2018, it began to expand its business model into other lending and deposit gathering initiatives, most notably digital assets banking to collect cash deposits and maintain operating accounts for various digital asset-related businesses. Signature experienced tremendous growth in deposits, primarily in large uninsured deposits during 2020 and 2021, resulting in the bank's size more than doubling, then experienced significant outflows in 2022 as interest rates began to rise and deposits began to contract due to volatility in the digital assets market. The primary cause of Signature's failure was illiquidity resulting from contagion related to Silvergate Bank's announced liquidation and the failure of Silicon Valley Bank on March the 10th of 2023. However, the root cause of bank's failure was poor management. Signature's board and management pursued rapid, unrestrained growth without developing and maintaining adequate risk management practices and controls appropriate for its size, complexity, and risk profile. Signature's total assets grew by 175% from 2018 to the end of 2021. In addition, Signature funded its rapid growth through an over-reliance on uninsured deposits without implementing fundamental liquidity risk management practices and controls. They didn't understand the risk of their association with the crypto industry or its vulnerability to contagion from crypto industry turmoil that occurred in late 2022 and into 2023. Again, Signature had a significant client concentration in digital asset deposits and sought to cater to digital asset companies. And then finally, Signature did not always heed FDIC examiner concerns and was not always responsive or timely in addressing recommendations from FDIC or the state, for that matter. Growth, deposits, and profits took priority over ensuring sound risk management and responsiveness to examiner concerns. The report notes that while the fallout from Silvergate and SVB was unprecedented and unfolded rapidly, it was Signature's poor governance and inadequate risk management practices that put it in a position where it could not effectively manage its liquidity position in a time of stress, and it couldn't meet very large withdrawal requests. With respect to supervision, the FDIC's New York Regional Office employed a continuous examination process that included assigning a dedicated team of examiners. The FDIC and the state conducted a number of targeted reviews and ongoing monitoring. The regulators issued 36 targeted review supervisory letters and 5 annual roll-up reports of examination during our period of review, which was from 2017 through 2023. Examiners identified recurring liquidity risk management and other weaknesses. They made numerous recommendations and devoted significant resources to evaluating the bank's operations and risk. Several recommendations related to liquidity risk management, Bank Secrecy Act and anti-money laundering, and model risk management. Many of those recommendations remained outstanding for multiple examination cycles. From 2017 on, the FDIC assigned a composite 2 CAMELS rating to Signature, which indicates that the overall condition of the bank was satisfactory. In 2019, the FDIC downgraded Signature's liquidity component rating to a 3, reflecting a need for improvement. However, the FDIC rated Signature's board and management performance as satisfactory until just before the bank failed. In retrospect, given the recurring liquidity control weaknesses, the bank's unrestrained growth, and management's slow response to address findings, it would have been prudent for the FDIC to downgrade the management component rating to a 3, meaning needs improvement, as early as the second half of 2021. Doing so would have been consistent with FDIC's forward-looking supervision concept. It likely would have lowered the composite rating, the overall rating, and it would have supported consideration of an enforcement action. We also concluded that examination work products could have been timelier, and communication with Signature's board and management could have been more effective. For example, targeted reviews and supervisory letters and annual reports of examination frequently exceeded elapsed day benchmarks, and in some cases were significantly delayed. And then a New York Regional Office Lessons Learned review concluded there were opportunities for examiners to engage more frequently with bank management and the board and provide clearer, timelier messages to Signature executives regarding identified weaknesses. Importantly, the FDIC experienced resource challenges with examination staff that affected timeliness and quality. During our period of review, the FDIC was not always able to adequately staff an examination team dedicated to supervising the bank. As a result, certain targeted reviews were not completed timely or not at all because of resource shortages. These resource challenges slowed earlier identification and reporting of Signature weaknesses. The report identifies multiple reasons for large financial institution staffing challenges, particularly in New York. The report also discusses actions that RMS FDIC has taken to address resource issues. While those actions are positive, we concluded that more work was needed. Our report included matters for further study related to examination guidance, processes, and resources. That concludes my remarks. Thank you for the opportunity to be before you.
Thank you. Before we take questions, we will hear from Dr. Harris.
Thank you, Chairman Sanders, for this opportunity to discuss the Signature Bank failure. And thank you, Representative Anderson, for joining us today at this important hearing. Before I start, note that I speak only for myself. I'm a professor of finance at USC Marshall School of Business, where I hold the Fred V. Keenan Chair in Finance, but I don't speak for USC or Interactive Brokers, where I'm the lead independent director, or various mutual funds for which I'm a director or trustee. A complete understanding of the failure requires considering it from different perspectives. Starting with the proximate cause of the failure, my comments will delve ever deeply until we identify the most important causes of Signature's failure. The proximate cause is well known and already well discussed today. Signature failed because it suffered a large uninsured deposit run that quickly exhausted its liquidity. If Signature had not suffered that run, it might have survived, almost certainly. A deeper understanding of the failure requires considering the conditions that caused the run. Sophisticated depositors with large uninsured balances feared that Signature might fail due to potential losses that might exceed Signature's capital. Signature was faced with declining business in the digital asset sector, potential credit losses on client loans, and losses on long-term debt securities caused by rising interest rates. It did not matter whether the losses actually occurred, would occur, or would never occur. Instead, fear of those losses caused the run. Large depositors recognized that if Signature failed, they would want to be first out. The recent failures of Silvergate Bank and Silicon Valley Bank undoubtedly promoted their fears. Many such depositors, coming to the same conclusion at the same time, overwhelmed the bank's liquidity reserves and caused Signature to fail, which, rightly or wrongly, confirmed their fears. Signature Bank might have survived if it had more liquidity reserves, a less risky business model, less risky investments, or more capital. The next level of understanding requires considering how Signature got into this losing position. Why didn't it have more liquidity reserves? Why did it commit so much to the digital assets industry? Why did it make risky loans and hold long-term securities? Why didn't it have more capital? And why did it expand so quickly during unfavorable banking conditions? At first blush, the answers to these questions are obvious. The bank was seeking profit subject to the various regulatory and market constraints that it operated under. The run would have been less likely if Signature had not allowed itself to become so dependent on deposits associated with the digital assets industry, had it responded more aggressively to the losses of those deposits, had regulators placed greater constraints on Signature's profit-seeking behaviors. Thus, poor management and poor regulatory oversight contributed to the failure. But this understanding is still incomplete. To fully understand the failure completely, we must consider the environment in which Signature operated when its managers made the decisions that led to its demise. Most importantly, interest rates were at extraordinarily low levels. Following the 2008 financial crisis, short-term T-bill rates dropped to less than 0.1%. They stayed low for 11 of the next 14 years through April 2022, rising only in 2017 to 19 to a peak of 2.5%. Signature Bank could have survived if it held more T-bills to back its uninsured deposits. But it could not have operated profitably on the implied 0.1% interest rate spread between the T-bill rate and the zero rate it paid on transaction deposits. No bank could. Including time deposits and money market accounts, Signature was paying 0.2% on all deposits in 2021, which is more than the T-bill rate. So Signature would not have been profitable if it fully covered its uninsured deposits with T-bills, which of course would ensure that it wouldn't have failed. So there were a number of alternative strategies that Signature and other banks could have pursued. Signature could have limited its deposits to the $250,000 FDIC minimum. But if they had done so, that would have precluded doing business with large commercial clients who often pay suppliers and employers larger amounts and therefore have to keep large balances. So that was a no-starter. Signature could have charged negative interest rates on large institutional deposits to increase its interest rate spread. This is what the European banks did when they faced similar conditions. But Signature's competitors were not collecting negative interest rates, and so this strategy also wasn't viable. I'll comment a bit more about this shortly. Signature could enter risky businesses, not unusually risky, but risky businesses, and make risky investments, again, not unusually so, with higher expected returns than T-bill returns. Signature, along with most banks, this is what they did. Finally, Signature could have tried to raise more capital to cover the additional risk, but the capital would have diluted the returns of existing shareholders. In retrospect, this strategy would have been best if they could execute it, but bank managers usually will not raise new capital unless compelled to do so, and they usually cannot raise it when they need it most. So now let's consider the deepest cause of the failure. Banking is a very competitive industry. The large systemically important banks compete with an advantage not available to smaller banks like Signature. The Fed effectively guarantees the deposits of these large banks, which are widely considered too big to fail. The systematically important banks are more highly regulated as a consequence, but the regulation costs these banks less than they gain from being large and having fully insured deposits. And the fully insured deposits, or the effectively fully insured deposits, creates a condition where anybody who's the slightest scared about having uninsured deposits in a other bank are going to jump to a fully insured bank. So these guarantees help explain why deposit rates never became negative, as they should have when T-bill rates were so low. The systemically important banks benefit from having guaranteed deposits. Lowering deposit rates below zero would have decreased those deposits, so they didn't want to do that. Had deposit rates been negative, Signature may not have taken as much risk. So Signature Bank, Silicon Valley Bank, and First Republic Bank, they all failed in part because they were playing on an unlevel playing field. In competitive industries, disadvantaged competitors inevitably fail. The immediate failure causes may vary and may be unpredictable, but the economic consequences of competing against advantaged competitors are unambiguous. And that's probably the deepest understanding of what happened.
Thank you. I've done you, the audience, a great disservice. What is your background, Dr. Harris? A little bit more of your history.
So I have a PhD in economics from University of Chicago many, many years ago. I've served as chief economist of the Securities and Exchange Commission for a couple of years. I am an expert in trading. I've spent a lot of time thinking about bank runs, though I've not written about them. And as I noted earlier, I have a number of important practitioner positions.
Yes, thank you. Just to, since I raised, has the issue or the idea of moral hazard disappeared from, it seems that it's on the ropes at best.
So if we're to look for a single cause for this crisis, it's related to but not due to deposit insurance. Now, deposit insurance has moral hazards attached to it. When somebody else insures your customers, then you're liable to take more risk, because if things work out, then your shareholders profit, and if things don't work out, then the guarantor of the insurer ends up taking the loss. And that's the source of the moral hazard that concerns us. We instituted deposit insurance many, many years ago as a way to stop what seemed to be an endless cycle of banking runs. And yet we see that we still have it. So there are a couple solutions to this problem. We could have universal deposit insurance, or even just enough insurance as Barney Frank's proposal suggested, just enough so that people are insured to the amount that they need. But as we expand insurance, then we have to deal with the moral hazard problem, which requires either a lot of regulation or alternatively a lot of capital. So if we demand that the banking system have more capital, then the first loss is going to be borne by the shareholders and the bondholders, and they tend to be careful. They ensure that the managers of the bank and the directors will protect their money. So if there's enough money at risk, then we don't need to worry as much about the moral hazard, and the banks will behave, presumably, generally, not always, will behave more responsibly. Having this difference between some banks are fully insured and some banks are less insured clearly contributed to the problem here. So if the large banks hadn't been fully insured, would some of these folks have jumped from one bank to another bank where they might have faced the same problem? It's obviously the incentives would be less, but clearly panics happen and we have to deal with it. So there are other ways of dealing with this, with the problem. We spoke of having full insurance. But another way to do with it is to say that all demand deposits, all fast money has to be covered by equally fast assets. So short-term treasury bills. And that effectively makes that function of the bank into a money market fund. In practice, we can do that by just requiring that the assets be segregated like we do in the brokerage industry to protect the depositors, the clients of the bank. People are reluctant to do that because they feel that that would reduce the amount of money that banks could loan by forcing them to invest in treasury securities. But in fact, there's tons of money out there to be lent. The present system gives an advantage to bank lenders over non-bank lenders. To the extent that banks can identify good investment opportunities, so good loans to make for housing, for commercial purposes, for industrial development, for whatever, to the extent that the bank managers can do that, and they tend to be really good about it, they can raise the capital to fund it. But there's probably no question that removing the subsidy from these banks will increase lending rates. And we have to ask ourselves, why do we subsidize only banks instead of other financial lenders? So we can demand more capital, but the banks don't like that. There's some dilution that results. But the banks will argue that the capital is really expensive, and that will increase the cost of loans. But in fact, the more capital a bank carries, the less risky the capital is. And therefore, the owners of the capital don't demand as much return.
Of course, that would have a lot to do with lending. Some say that we get less loans out there, but we'll return to that.
I ultimately don't think that's the case. Yeah.
Well, we're in a brave new world. We may
Yeah.
indeed find out.
And very quickly, if you'd like, there's one final way to deal with
Please.
this, which is if we can reduce demand deposits by making transactions, the transaction technology more efficient and quicker, then the size of this problem decreases. So electronic methods of paying bills, of sweeping money in and out of money market funds, things like that, reduce the reliance of the banking industry and its clients on deposit insurance and on deposits in general. So if we can reduce the size of demand deposits and other fast money by improving transaction technologies, we will reduce this problem. Now that's actually happening, so even if we do nothing, there'll be some improvement in the future.
Food for thought.
Probably not enough, but yes.
Much food for thought. Mr. Gentry, I believe that you are familiar with this document.
Yes, sir.
And I believe that you are the prime author of the document.
Yes, sir.
You've given me many a night of reading, sir. And I suspect that you are familiar with the New York State version of it also.
Yes, sir.
What would of the conclusions, where do the conclusions differ? Where do you differ with New York State's interpretation?
I didn't really see a lot of difference between the conclusions of the two reports. We did coordinate a little bit on the review with New York State.
I must compliment you on your storied history. You've been in the thick of it, at the front line of every banking fiasco on the positive side, mind you, of every banking fiasco in the last 10, 20 years, sir. How does this one differ with the 2008 or these other periods? How does this period differ with those?
Yeah, that's a good question, and I think there's definitely some similarities and some differences. The difference is, I think this time around it was more on the funding side. In 2008, many times the failures were more related to the asset side, loan issues, problem assets. things like that.
The predatory loans and things of that nature.
Or loans that went bad, that borrowers could no longer pay
Yes,
for. And some of them were predatory, certainly. And that slowly ate away at the bank's capital. So it was a much slower failure usually. The recent failures were all liquidity related, meaning the banks ran out of money. They still had capital, but they didn't have money to meet deposit demands. And so that's a difference, I think. We didn't see that as often in 2008. I think what is similar and a theme throughout the report is that on the regulatory side, well, on the bank side, rapid growth. That was a big problem in 2008. That's a problem with these banks this time around. And then on the regulatory side, the use of forward-looking supervision. So regulators need to address risk management weaknesses when they see them before financial decline occurs. And that didn't always happen in 2008, and we see that as a similarity this time around. There were longstanding liquidity and other issues with Signature Bank that the regulators identified but didn't escalate their regulatory action.
Why not? Why didn't the regulators just take the next step and say, wait a minute, we've got a mess here, and let's at least downgrade?
I think it's similar to what we saw in 2008 when the bank either has a lot of capital or is earning money, or in this case, Signature had just a lot of liquidity for a couple of years as their deposits increased. It makes it more difficult for regulators to address those risk management weaknesses because they see the bank is earning money or has a lot of liquidity or has a lot of capital.
In 2008, sir, it was an allegation that regulators didn't move on this issue because politics was in the way, from the White House down, folk wanted an easy money supply. They wanted the ability for people to get loans, and the emphasis was on buying homes. What role did politics play in the failure of Signature Bank and any of these other banks?
Yeah, I don't think we really saw that politics did play a role in Signature. I think you maybe saw a little bit of that in the Fed's report of SVB because they talked about the enhanced prudential standards being raised from $50 billion to $250 billion. We didn't really see that as much with the Signature situation.
I draw everyone's attention to the Federal Reserve, of course, where one of the, if my memory serves me correct, the president of SVB Bank was a member of their Federal Reserve. Mm-hmm. It seems, does that strike you as good practice, sir?
I can only speak to the review we did of Signature,
course.
Respectfully.
Oh, not bad, not bad. You'll go far in this business. How about you, Dr. Harris? Does that strike you as good practice?
There's a tension between the expertise that such a person would bring to the local Federal Reserve branch.
Interesting.
And the potential conflict of interest. While expertise is rare, it's not isolated. Overall, I would say that it clearly raises concerns.
Mm-hmm. Mr. Gentry, you you heard the earlier speaker say that at best, I raised a question of what percentage of blame, if you wish, mm-hmm. the management of Signature Bank has. I trust that you heard what I heard, that it was far less than 20% or something of that nature. Would you agree that that assessment is correct?
No, respectfully, I would not. I believe a much more preponderance of the blame goes with Signature Bank management. As we say in the report, Signature Bank management and board and management was responsible for the failure of that bank. There are things certainly that regulators could have done to escalate actions earlier, but regulation is there to help make sure that banks operate safely and soundly and to ensure financial stability, but not necessarily to prevent bank failures.
Since I used a very simplistic percentage, what percentage would you give to management? You heard maybe 20%. What percentage would you give to management?
I don't know if I could assign a percentage, but I do disagree with the prior speaker's statement that what could they have done to avoid that. I think there are a number of things they could have done to avoid being in the position they were in. We talk about those in the report. They could have curbed their excessive growth. They could have limited their concentrations in an area that was risky, the crypto area, and volatile. They could have reduced their reliance on uninsured deposits. They could have held more on-balance sheet liquidity, and they could have been more responsive to regulatory recommendations. And those were all things they could have done leading up that would have prevented the situation that they were in.
A question to both of you. I guess I'll go to you first, Dr. Harris. A previous speaker spoke of the irrational nature of withdrawals, that people were just the fear had paranoia, I believe he called it, had overtaken people, and the fear itself was driving people to take their money out of that particular bank. Is this a good description of what happened?
It's certainly very important, but I take issue with the use of the word irrational. The people who removed their money were making rational decisions under uncertainty. They weren't in a position to determine whether the bank was going to be liquid or even whether it was solvent. And it was very low cost for them to move their money to another bank. And they all understood that the sooner they did it, the better off they'd be, because if in the end we didn't guarantee all deposits, those left behind would be holding the bag. And so they did behave rationally and predictably. The challenge for policymakers is to ensure that we don't get into a similar position in the future.
Sir, Mr. Gentry, how about you? Was it an irrational act by people?
I think it was unprecedented in its scale and how quickly it unfolded. I would agree that it was not irrational. The problem, I think, also was with some of these banks. It was concentrated. Anytime you have concentrations, put all your eggs in one basket, that can create additional risk.
We're in a brave new world of digital transactions now, where the previous speaker did point out that these are done in seconds. We're no longer, you don't have to run to the bank. The Jimmy Stewart analogy that was raised earlier, you don't have to stand on some line, etc. I don't know how long it takes. I suspect that in a few seconds, for anybody really versed in this, you could move millions of dollars. What can New York State do about that issue, sir?
Yes, I'm sorry, sir. I can only speak to the review we did of Signature Bank. I think that is a policy issue that the FDIC and the other regulators are definitely going to be studying and grappling with. We do have a recommendation in the report for FDIC to kind of consider risks associated with uninsured deposits and what guidance they should give to their examiners going forward. I think that would be part of the answer.
I will return to that. Any advice that you would give us on the the nanoseconds that it will take to move money, huge amounts of money this day and age.
As a specialist in trading, I know a lot about nanoseconds. Their trading's very, very fast, and this is effectively a type of trading. You can't stop it. You have to. A rule that says that you have to give a week's notice before you move is not going to work. Although we do have this problem with money market funds, and the question, and we're debating it right now in front of the SEC. Should we have something called swing pricing, which says that if everybody wants to leave at once, should we price the fund accordingly? Recognizing that when everybody wants to leave, there are costs. Some of those costs are simply the transaction costs of selling the assets that back the deposits. But it's a big issue. The main thing is to address the environmental concerns that the large depositors have, to ensure that they don't become afraid and try to run out. And so for that, we either have to have more backing assets that are required for everybody who is offering these types of demand deposits, or we have to have more capital behind the entities that sponsor these deposits, or we have to have more insurance to ensure that people remain confident. If we do have more insurance, though, we either have to have more regulation or more capital. We see that there have been regulatory failures throughout history, and one could argue that this perhaps is also a regulatory failure. So I'm much more comfortable asking for more capital, because capital is a really good substitute for regulation. People self-regulate when they recognize that their money is at risk. But depositors aren't in a good position to do that, because they're, you and me and other people who are not well informed, and it's not their business to know everything about a bank, like Barney Frank mentioned. But the equity investors and bondholders, these are typically professional asset managers who spend a lot of time doing research. And their careers are on the line when they make bad decisions. And their sponsors, the pension funds that invest in these entities, and the insurance companies and individuals and others, they all care deeply about whether they're going to lose money. So they pay very close attention to the asset managers who they hire to manage these assets. And these people are capable of making good decisions about bank managements and the quality of the boards of directors if they're properly informed. And so an important role of government is to ensure that there's adequate disclosure. This is the SEC's role and the FDIC's role, so that people can fairly evaluate the quality of the institutions in which they're investing. And so moving that risk into the shareholders and into the bondholders is really the place where it needs to be. Trusting our regulators to control that risk is an alternative that's attractive but dangerous, because the regulators don't have their neck in the guillotine to the same extent that investors do.
Mm-hmm. A final question for you, Dr. Harrison, and then a request for you, Mr. Gentry, to summarize your, what lesson for New York State? You gave several recommendations. If you can try to put them in a type of order, what is the most important based on Signature Bank, based on Signature. But for you, Dr. Harris, I will, since you are a doctor, I'm going to go to the question of moral hazard. I'm going to, do we need to change the 250? Is the 250 gone? But a previous speaker also spoke of a New York State perhaps needs to come up with their supplemental insurance, as I believe he said Massachusetts does. Is this a worthy effort for New York State?
So increasing insurance without increasing capital requirements or additional regulation will cause problems again. We saw effectively, these were the problems that we saw in the savings and loan crisis now, 2, 3 crises ago. I mean, just one after another. Every 5, 10, 20 years, we get these crises. And a lot of it has to do with the problem of bank runs and the insurance that we put behind it. The way to deal with moral hazard is to, if we're going to insure, and I think it's essential that we do, the way to deal with it is to require so much capital behind in front of the insurance that the insurance really doesn't become a burden to society. So these failures are not costing the American taxpayer directly, but they're being spread over all the other banking institutions and ultimately are going to hurt the depositor. So we've hidden them, but there's been a huge transfer of money. As we're talking about transfers of money, we should also mention, as we haven't yet, that the shareholders, and perhaps the bondholders too, lost a lot of money with Signature and with these other banks. And while often we're not all that sympathetic to shareholders, I would note and would tell Assemblyman Anderson that many of those shareholders are the pension funds that look after the common people in their retirement. And so pension funds have been hurt with this change, as have insurance companies who provide a lot of services to the common public person, and the mutual funds that also hold these securities. So we have what would appear to be a pretty well-functioning bank that had problems, but I think all banks have problems. The fact that it had a CAMEL rating of 2 probably suggests that nobody was particularly concerned about it. And I suspect if we look at other banks that have CAMEL ratings of 2, we'll also see that there are regulatory issues that are unresolved. So I don't know that. I'm not that deep in it. But I suspect it's out there. The fact that a bank that seems to have been doing well, it didn't have ridiculous profit margins, it was doing well, we had a lot of value destroyed here that should be of great concern. I mean, this one did not appear to be insolvent. It just didn't have adequate liquidity. And we'll fault it for failing to plan. But all the suggestions that Marshall Gentry has raised, and I raised as well, are suggestions that reduce the profitability of the bank. And if all of them were undertaken, or any of them undertaken to the degree necessary to ensure that we wouldn't have the bank, wouldn't have bank runs, then we wouldn't have bank profitability either. And the banks aren't entitled to profits, but if there weren't profits, nobody would invest in them, and we wouldn't have banking either. And so then we get to the question of, well, how do you best regulate those profits? We can ask regulators to do it by saying that you must hold a certain amount of liquidity and you must have not too much concentration in every ratio and so forth. We have an entire industry of people trying to regulate banks to deal with these problems. Alternatively, you can just have a simple regulation that says you've got to have so much capital that you'll self-regulate yourself. And had we done that, well, then that capital probably would not have been destroyed in this case because the bank wasn't insolvent. That's really troubling. This is what appeared to be an innovative organization that may have had little edgy places where they were going wrong, but we all do, and it's lost. And all the shareholders, the pensioners and so forth, they were hurt because of it.
I will return to the question, Dr. Harris, that if we did have these capital safeguards that you spoke of, that they had to have that much capital, the real question that people would have come up with is, would the banks have lent? Would we have created new capital under those conditions? I heard you earlier say that you believe that it would have happened, or it may happen under those conditions. It's
So
food for thought.
when we require banks to have extra capital, the fear is that's expensive and the banks won't be able to lend as much. But the truth is that when banks are really well capitalized, the say equity capital is less risky, because the risks of the bank loan, the loan portfolio, is spread over more shareholders, the residual risk. And as a consequence, people don't demand as much of a return to hold less risky capital. And so as we require more capital, the cost of capital actually decreases. There's a famous theorem in finance about this. Now, there are some tax consequences about it, but they're of second order. So one of the reasons that the tax consequences are that the more you finance by borrowing, the more you can deduct, and the lower, you deduct the interest, and then the lower your tax bill is. But that's a second order issue. If people want to have a levered investment in a bank that's not highly levered, that has a lot of capital, they can just borrow money on their own name and invest it by buying more bank stock, and they can get the same leverage that we presently have. And then their borrowing is also deductible because it's for an investment. So this is called the Miller-Modigliani theorem. It's well known, but it's not well understood. But we do know that if we ask the banks to have more capital, if they have good investments, there will be people who want to participate in those investments, and they'll produce the capital. And there certainly is enough Treasury bills outstanding to cover all of our deposits. And we know that because the money market funds are so large, and they're largely covered by short-term, highly secure securities.
We will, on another day, we'll return to that. Mr. Gentry, lessons for New York based on the Signature Bank.
Yes, sir. And could I just respond just to one,
Of course,
one or two
by all
things?
means.
So one, I respectfully disagree with respect to Signature's bank. They were an outlier, as was SVB and as was First Republic. Signature Bank grew by 135%. Their peer banks grew by about 35% over that same time frame. Their level of uninsured deposits was double that of their peer group, other banks of kind of similar size and complexity. And they were into some areas, crypto, that were volatile. So I don't think they were a low-risk bank by any means. With respect to deposit insurance, I just wanted to mention also, while this wasn't something that my group was looking at, FDIC recently put out a deposit insurance options study. One of the options that FDIC has said might have the most promise is targeted deposit insurance to cover business accounts, such as payroll, which was a big issue with these banks failing. Those weren't the kind of accounts that got Signature in trouble. I mean, Signature had huge accounts. They had 60, I think we say in the report, 60 of their depositors had accounts of $250 million and more. 4 depositors, 3 of which were in the digital assets space, had deposits that accounted for 15% of the bank's total assets, so 15, 16, $17 billion. Those are much more than standard payroll accounts. Those are the ones we need to control a bit more. But so FDIC has issued an options paper and will be working with Congress on some of those options. With respect to your question, though, lessons learned, I think the big lesson probably for us and for New York State, which I know Superintendent Harris is already working on and has been working on in her tenure, is staffing. There is a shortage of regulatory staffing, especially in New York. We saw that played into the supervision of Signature Bank. That's something that we definitely need to work on, both in the large financial institution specialist area, as well as the pipeline of examiners that come through our system and graduate to that large financial institution level. The second area, as I mentioned earlier, is forward-looking supervision, just reiterating that philosophy that it's really important to address risk management weaknesses, controls, corporate governance when examiners see them, and not waiting for financial decline or capital erosion or liquidity issues to happen. And then third is a better escalation path for when you see recurring recommendations, examination cycle after examination cycle, for increasing either ratings downgrades or enforcement actions. Those, I think, are the three probably biggest lessons learned to come out of the report.
Well, I want to thank you, sir, and I want to thank you also, sir, for coming and trying to put some light on a very sometimes murky issue. Let's do it different. A little understood area, very important, but little understood area. We only see the importance of this area in times of crisis, when people didn't understand or tried to take advantage of. We will see this more. And we are fortunate that there are people who spend their time and energy understanding these things. To you, Dr. Harris, for your life's work, and for you, Mr. Gentry, I suspect you're not done with this business yet. Wouldn't it be nice if there were no other cases in your tenure?
Yes, sir.
That,
Yes, sir, would.
That this was the last, then you could just write the book. I suspect that America will give you at least one or two more before you decide to let it go. To the both of you, I thank you very much for appearing. I hope that it wasn't too painful.
Thank you, Senator.
Thank you very much.
Thank you. I will remind people that the Senate and the Assembly is full effect right now. We are all over the place doing a billion different things as we careen towards our last day here, for a while, of course. Would you mind calling the next panel?
Louis Cholan Brown.
Would you name it again, sir? Paul, would you call it again?
Oh, Louis Cholan Brown.
All right. Going once. Oh, I'm sorry.
Here.
That's a sign when you've been up here too long, sir.
No worries, Senator.
Mr. Cholan Brown, good to see you.
Good to see you.
With you, by all means, please start.
Great, thank you. Good afternoon, Chair Sanders. My name is Louis Cholan Brown. I'm the Senior Advisor and Special Counsel for Policy and Innovation. And on behalf of the New York City Comptroller, Brad Lander, I want to thank you for the opportunity to testify this afternoon. Senator, the Comptroller wanted me to start by thanking you for joining us at the first public hearing of the New York City Banking Commission last week in advance of the designation of city depository banks. We share your passion and commitment for ensuring that all New Yorkers have access without discrimination to the safe, sound, and secure banking and credit they need to participate in the economy, buy homes, start businesses, save for the future, and contribute to our shared thriving. The solvency and conduct of New York State chartered banks is of vital importance to individual New Yorkers and businesses who place their deposits in their care and those whose businesses and homes are financed by these institutions. Signature's poor governance and unsatisfactory risk management practices were well known to the FDIC and state regulators. These practices prevented the bank from adequately managing its liquidity risk, as the bank more than doubled in size between 2019 and 2022 from $47 to $110 billion and grew its assets by 134%, far exceeding the 33% median growth in total assets for peer banks. The concentration of consumer deposits, with 40% of total deposits coming from just 60 customers and 14% of those deposits belonging to just 4, and the unstable nature of uninsured deposits, which reached 82%, approximately twice that of peer banks, were long evident. These red flags make clear the need for prudential regulators to regularly review the deposit structure of banks. To be fair, the FDIC and New York DFS took numerous supervisory actions to mitigate liquidity and management deficiencies at the bank, including downgrading Signature's liquidity component from 2 to 3 during the 2019 examination cycle. Many matters and recommendations like this one carried over to later years because they went unresolved. Ultimately, awareness and identification of weaknesses by the FDIC and DFS were not the problem. Rather, supervisory action lacked forcefulness. We support the recommendations articulated in the April 28th DFS report, especially revisiting the assumptions used to model and manage liquidity risk and strengthen regulatory tools to hold executives accountable for misconduct that leads to the failure of a financial institution. Thankfully, Signature's failure was of limited harm to the City of New York. While the city's 5 pension funds and universal investors invested broadly across the economy and therefore held stock in most major U.S. banks, they were slightly underweight in regional banks during this period, which helpfully served to moderate our modest losses there. The funds, which currently have over $250 billion in assets under management, held less than $2 million in stock at Signature Bank and First Republic Bank combined, or less than 1/1000th of 1% of fund value. Signature Bank was a city depository bank with approximately $30 million on deposits. These deposits, like other uninsured deposits over $250,000, were, as you know, ultimately covered by the FDIC. The city charter also requires all of our banking deposits to be fully collateralized. In light of the failure of Signature Bank, the New York City Banking Commission conducted additional reviews of the soundness of all applicants for designation during our recent review process, including an analysis of uninsured deposits. We granted a 1-year designation to allow for the city's deposits with Signature, now owned by Flagstar Bank, to continue pending Flagstar's completion of the relevant application paperwork. In addition to the risks and harms as a result of Signature's high level of uninsured deposits, which are now covered by the FDIC, I want to focus my remarks on the risks presented by Signature's commercial loans on multifamily properties and especially on rent-stabilized housing in New York City. Signature was the second biggest commercial real estate lender in the city, holding $33 billion in loans last year and a 12% share of the bank CRE lending market in the New York metro area. Its failure is therefore of significant concern to the approximately 80,000 tenants of the 3,000 multifamily buildings with Signature loans. To be clear, the risks to these tenants are not only as a result of the bank's failure, but also from the way that many of these loans were underwritten in the first place. Even though 80% of the loans were for rent-stabilized properties for which annual increases are regulated and tenancy is protected, many were calculated with the expectation that the rent roll would rise 15% a year, many times what allowable regulated increases have been in recent years. Some of these loans were even configured to provide specific funding for cash buyouts of tenants. In other words, the business model for these loans was premised on tenant displacement. Approximately 40% of these loans predated the 2019 passage of the Housing Stability Tenant Protection Act, which narrowed landlords' abilities to engage in such behaviors. 1/3 of the owners on the New York City Public Advocate's 100 Worst Landlords list, whose properties abounded in housing violations, accumulated debt, held loans from Signature. All told, Signature's multifamily portfolio racked up over 64,000 open housing code violations as of January 1st, with more than 80% of those classified as hazardous or immediately hazardous. Over the past 5 years, 45% of these properties were included in HPD's alternative enforcement program due to their dire conditions. Of the Signature portfolio, the University Neighborhood Housing Program, UNHP, estimated that 3.86% of the portfolio is likely financially distressed, and over the past 5 years, housing code violations increased by 113%. Regulators were aware of the scale of Signature's affordable housing investments and chastised the bank with its significant increase in total assets and securities for not pursuing other qualified investment opportunities, include those that are not LIHTC related. They were also aware of the ongoing problem of bad landlords who continue to own and operate multifamily buildings that are deteriorating, and that landlords appear to engage in various forms of harassment tactics to encourage current tenants paying lower level rents to move out in order to move the properties to full market rate rents. In 2014, DFS issued guidance stating that banks will not receive CRA credit for multifamily loans leading to tenant harassment, displacement, or poor conditions, regardless of the rent levels at the time the loan was made. Subsequent 2018 guidance sought to ensure that all state-chartered banking institutions did not knowingly or unknowingly facilitate landlord schemes to harass tenants and violate New York rent regulations. Banks were instructed to follow best practices of pre-loan due diligence, including engaging with tenant organizations and reviewing tenant lawsuits and complaints, establishing debt service coverage ratios, utilizing current in-place rents without assumptions that the landlords would increase rents on the turnover of the currently occupied rent-regulated units, and ensuring that loans become displacement financing, including the use of the loan for the purpose of tenant buyouts. In the months preceding the 2018 guidance, Signature released its own multifamily lending best practices pledge with the Association for Neighborhood and Housing Development, ANHD, that purported to set a high standard of commitment to ensure that mortgage lending does not contribute to displacement of tenants. However, in the more than 4 years since, the bank often failed to live up to these commitments. Though ANHD and others were vocal with regulators about this conduct and the need for consequences for financing predatory practices, Signature was rated satisfactory overall and passed its March 2022 CRA exam despite failing 2 of its 4 assessment areas and 3 of the 12 subtests. We urge DFS to review its community reinvestment criteria in light of Signature's failure. On March 23rd, our office sent a letter to the FDIC and DFS raising concerns about the potential sale of Signature's commercial real estate portfolio and requesting that the regulators ensure that the purchaser of these notes be required to comply with the standards of multifamily lending that Signature had agreed to in July 2018 and that were sent out by DFS guidance. We were encouraged to see a public statement from the FDIC in the weeks following, acknowledging their statutory obligation to maximize the availability and affordability of residential property and paying particular attention to the rent-stabilized and rent-controlled housing stock. In addition, the FDIC is committed to engaging with government partners and community-based organizations in the disposition strategy. We are committed to working with regulators, other state and local elected officials, and community partners to find an outcome that results in tenant stability and improved housing conditions. Thank you again for the opportunity to testify and for your ongoing work to ensure that New Yorkers have access to safe, sound, and secure banking services.
First, let me thank you for coming up here. How was the trip up here?
Lovely. I always enjoy it.
Well, you've got me beat then, sir. Under those conditions, let me thank you, and please take a message back to my friend, the controller, Brad Lander, that it was a joy testifying at his hearing. We need to do more, and of course, that hearing brings my first question, sir. If Signature Bank was such a such a bad player, why are we putting our money into players of this nature? Why were they able to get into the banking system? Why is I believe the state and the city putting money into a bad player?
Sure. So, I mean, as you know, the comptroller has led a lot of work over the past year, including the hearing that you attended, to reform the banking commission process and ensure that banks are not only stable but committed to anti-discrimination and fair lending practices. As I said, given the transfer from Signature Bank to Flagstar, right, the New York Community Bank, the Banking Commission elected to give the bank a 1-year extension in lieu of the 2-year term that the 26 approved banks received, and that will allow the commission to next year engage with the Flagstar leadership about what practices they are going to carry forward. And we also are grateful to know that Flagstar and New York Community Bank have committed to retaining the community benefit agreement that Signature had, and we will work with them to make sure they meet those standards.
I'm glad you said that. I didn't understand the 1 year, giving them a 1 year until now. I said these bad players. However, it is true that if you have a new administration come in, it is quite unfair not to give them a chance to correct the practices and to continue with the best policies that Signature Bank did come up with. So your reading of Signature Bank, we've heard two different ideas here. One idea was that the management, there was nothing that the management could do here, that this was beyond the hands of the management, that this was irrational, withdrawing, people hearing the cryptocurrency problem or cryptocurrency debacle in California and other places, and they decided that they wanted to take their money out of Signature Bank. On the other hand, we've had at least two different speakers who spoke of that's not exactly the whole story, and it had much more to do with the management. Where does your office lie on this issue, sir?
So I'm going to have to defer to Superintendent Harris and the representatives from the FDIC who were here. I will say that as part of the Banking Commission review process, the Commission conducted an enhanced soundness review of all the designated banks, and the Commission was content that Flagstar is a sound institution currently.
In terms of New York State, in terms of what we can do, whether it be at the Banking Commission in New York City, for those who don't know, there is a commission composed of the Controller's Office, the Treasurer, and the mayor has an appointee. And I agree with what you were saying earlier that well, let me do it different. I'll speak for myself. The commission in days gone by has not looked at much beyond dollars and cents from my point of view. And there are other needs and demands of by the people of New York that are good business practices. I am glad that the controller sees a much more activist position for the commission. In light of your understanding of the commission, in light of those things, in light of, especially in light of Signature Bank, are there any advice or guidance that your office would offer?
Again, I think that, we think that New York DFS, April 28th, sort of post-mortem of Signature and their supervision, laid out a number of important reforms and recommendations that we support, including around how we model liquidity, as well as potential consequences for bank executives whose practices lead to misinformation and the kind of circumstances that we saw. But the Banking Commission ultimately has a fairly narrow authority. We are not a bank regulator, unlike DFS or the multiple federal regulators. So we rely heavily on their analyses and their exams and the hard work they put into them to assist us in ensuring that city deposits are safe.
Well, with that one, Mr. Chilton Brown, I really appreciate that you picked a great day to come up here. I'll give it that. And if you're going back by Amtrak, you want to get the side that faces the Hudson. It'll be a
I always
spectacular.
do. Well, thank you so much, Chair.
Thank you very much, sir. Good to see you again.
Good to see you.
You can call your next panel, sir.
Renita Marcelin, Chuck Bell, Marika Williams, Will DeFoo, and Andy Morrison. Please approach the table.
Renita?
Rika's here.
And these are mine. Thank you.
Rika and Will.
Thank you.
Welcome. Anybody's first time to Albany? Ah, welcome. Did
I'm
you
from Brooklyn.
Did you come up by the Amtrak?
Yeah, I came from DC.
Ah, then you make sure that you're facing the window on your way back. It's much more pleasant. I believe you, Mr. Morrison, know your way here by now?
Yes.
He, of course, has been here so many times. I thought he had an office here for a while. Then I found that he does. So I'm really grateful that you are here. We're going to explore something that is near and dear to all of our hearts. And I'm going to, I guess I will go from my right to, which is your left, and we'll go this way. And if you would be kind enough to speak and identify yourself and your organization, and then give us your take on, you want her to go first?
Yes.
Okay, I can work, or we can, I just was trying to keep it up, keep going. I get lost quickly, but you'll help me out.
Hi, good afternoon. Thank you, Chair Sanders and Ranking Member Borrello, in spirit, for the invitation to testify before the committee. My name is Renita Marcelin. I am the Advocacy and Legislative Director of Americans for Financial Reform. I should say that Consumer Reports is one of our strong and proudest allies, so thank you, Chuck.
Clearly.
Yes. And as a born and raised Brooklynite from East Flatbush, it is an honor to be here. In 2018, among the flurry of lobbying being done by the mid-sized banks to roll back many of the provisions in the banking reform bill known as Dodd-Frank, Signature Bank's chairman Scott Shea publicly said, "We strongly believe that we are not even in the same zip code as being systemically important." On March 12th of this year, Secretary Yellen, following the recommendation of the FDIC, Signature's primary federal regulator, invoked the systemic risk exception of the Federal Reserve Act when deciding to close Signature and guaranteeing all deposits within the bank. Signature Bank, along with many other banks dubbed mid-sized banks, successfully lobbied in 2018 to remove enhanced requirements placed on large banks such as stress testing, capital and liquidity requirements, and resolution planning. Although sometimes referred to as mid-sized banks, Signature and others placed in that category are indeed very large. The name mid-sized banks is simply the result of them being compared to the JP Morgans and Bank of Americas of the world, a dangerous comparison because it leads many to fall for the notion that their smaller size should equate to a lighter regulatory touch. At the time of its failure, Signature Bank had $110 billion in assets and almost $89 billion in deposits. According to DFS, as we heard from Superintendent Harris today, between 2019 and 2021, Signature launched a number of new business initiatives. The bank's assets doubled and its uninsured deposits tripled. In 2021, uninsured deposits made up 82% of Signature's deposit base. However, as the bank grew, it lacked the robust risk controls needed to effectively monitor a bank its size. It was the fourth largest bank to fail in U.S. history. Regulators at the state and federal level must appropriately acknowledge the risk these banks pose, although they are not as complex and interconnected as the mega banks. The problems present at Signature Bank, rapid period of growth without adequate risk management, high percentage of uninsured deposits, and high concentration of deposits is not unique to Signature. These factors also led to the failure of First Republic and Silicon Valley Bank, and it has been reported that many of the banks in a similar asset class also hold a disproportionately high amount of uninsured deposits, as was mentioned earlier from many of the folks who testified. Yet, because of the Economic Growth, Regulatory Relief, and Consumer Protection Act, also known as S2155, the bill that Chairman Scott and his peers heavily lobbied for, that repealed many of the safety and soundness guardrails created by Dodd-Frank, regulators and supervisors, including at the FDIC, scrutinized these banks less as the belief that they were inherently safe took hold. On one hand, we can say that Signature's failure is the result of the bet these executives made, by not only lobbying for lax rules, but also by poorly managing their banks. However, the consequences of Signature's failure is not contained to only Signature's executives. The consequences include the public's confidence in our banking system being tested again for another time within 15 years. The public again witnessing the extraordinary actions our federal government is willing to take to rescue the well-connected few, while so many struggle to make ends meet. The scores of bank tellers and non-executive employees at this bank who are now unemployed, and the implications of the effectiveness of our banking laws if these crises are now periodic and the responsible executives come away virtually unscathed. Not only unscathed, but often enriched by executive compensation plans that reward risky behavior. Regulators, supervisors, and lawmakers must grapple with these realities. In the very least, Congress should repeal S2155 and return to the enhanced prudential standards set by Dodd-Frank. The federal regulators can and should use their current authority to better regulate banks between 100 to 250 billion in assets. Regulators must also restore a culture of robust supervision among the regional offices. Additionally, Congress should arm the FDIC and other regulators to call back compensation. The Fed should finish rulemaking to properly govern systemically important non-banks, especially as we see the outsized growth of the private equity industry and how we saw in 2008 how AIG and MetLife brought our economy to its knees. Lastly, and probably most importantly, policymakers must acknowledge the public element of banking and how banks serve as agents of the Federal Reserve by creating money. This fact that banks serve a public utility is partially why governments are quick to rescue banks. Because of this, Americans for Financial Reform has been a supporter of public banks. The United States had a public banking system based in the post office for over half a century, from 1911 to 1966. Funny enough, the idea percolated among reformers before the Panic of 1907, when excessive bank failures wiped out the savings of many, and this led to broad political support for public banking. The equity arguments for a public banking option are strong. Imagine a system where people can access simple banking services via the U.S. Postal Service. Our report released last week, Banking Fair, the Promise and Urgency of Doing Postal Banking Right, calls for a public banking option to be restored within the U.S. Postal Service. Our current banking system has failed so many, including the 10 million unbanked households, most of which are Black and brown families. Public banking will provide an opportunity to give more households access to the financial system, a key factor in wealth creation. Interestingly, we are about to recreate a public option for one important part of the financial system, payments. In July, the Fed will launch FedNow, a real-time payment system, and it's about time. Currently, 56 countries, including India, South Korea, the UK, Japan, China, and Nigeria, developed the infrastructure to allow real-time payments. Policymakers must continue to think about providing public options for services so widely used they should be considered utilities, including banking. AFR continues to support efforts here in New York, Massachusetts, and California to create state public banks. And thank you once again for the opportunity to testify before you today.
Thank you.
Thank you. So I'm Charles Bell, Programs Director for Consumer Reports. I just wanted to strongly say that I agree with what Renita has just presented here. We're proud to be a member of Americans for Financial Reform. And actually, we were present in 2017 and 2018 as citizen advocates to lobby for the retention of the stricter requirements on the small regional, quote-unquote, smaller regional banks that were lifted when S2155 was passed. And we did our best to communicate the concerns that communities have about banking oversight and supervision. Two of the scariest words in the English language are systemic risk when it comes to banking. So if you have a few banks that close, we catch, consumers and small businesses catch cold, but if many banks fail, we have pneumonia, right? And so we are fortunate that the federal and state regulators acted quickly to stem the contagion coming out of Silicon Valley Bank and the Signature Bank failures. But we need to heed the lessons that come from these postmortems to make sure that we are taking account of the unreasonable risks that are in the banking system. And as the DFS has reported, the way that the banks calculate risk related to liquidity needs to be rethought and recalibrated so that there are new regulatory mechanisms that really need to come into play here to protect consumers and small businesses from future bank failures. We see there are large numbers of other banks that have high levels of uninsured deposits from small businesses and other large investors. Then also, many banks are exposed to risk from construction loans and from commercial real estate, which may reemerge in the months to come. So I don't think we're completely out of the woods with this by any means, and I really commend the committee for its oversight and investigation into the bank failure. One of the concerns also has been, do the regulators have enough qualified staff to do their jobs? As Superintendent Harris said too, will they be able to escalate their concerns when they find unreasonable risks? They have to act quickly. And we also saw in this case that misinformation and social media, digital applications could play a very big role in increasing the risk of a bank run. And we need to be addressing those things too. So systemic risk has evolved, and there's a lot of new steps that need to be taken. But I would agree with the director of the CFPB who said there's no question, there was poor management at these two banks, but we enabled this by relaxing the requirements on the systemically important banks. And so the federal government and Congress should have maintained those higher standards, and we're hurt because they didn't. I think we'll also hear from our colleagues from ANHD that there is a bank failure within a bank failure, that even prior to March 12th, the lending activities of Signature Bank may have contributed to tenant displacement and poor living conditions in many of our multifamily buildings in New York City. And that's a real concern, that the regulators need to be on top of that too, to make sure that that lending supports community goals and community needs. And so the final item that I would conclude with is we really want to urge Assembly Speaker Hastie and Majority Leader Andrew Stewart-Cousins to please let the New York Public Banks Bill come to the floor for a vote. That would empower New York's local communities to form public banks and form lending systems that will benefit local communities, including and especially for affordable, sustainable housing. So thanks very much, and I've contributed a written statement for the record.
Thank you very much, Ms. Williams.
Thank you, Chair Sanders, and thank you to the committee and the members of the Senate Standing Committee on Banks for the opportunity to testify on Signature Bank's collapse. And I also want to applaud you and you all for taking steps to actually have a hearing for us to get down to what happened, because as somebody else just said, this is potentially not the only failure within a failure that we need to be concerned about. I also want to recognize and applaud New York City government, New York State government, the AG's office, and especially the FDIC, who at this time are collaborating and working together, and specifically having conversations with community-based organizations in a different step. I hope that we hope gets us to a better outcome. I won't go into ANHD is one of the city's leading policy advocacy technical assistance organizations who focus on winning affordable housing and thriving economic opportunity for all New York City neighborhoods, and we work with a membership of more than 80-plus neighborhood-based nonprofit organizations. Essential for this conversation is that we coordinate and staff the Equitable Reinvestment Coalition, ERC, which focuses on how we invest in and reinvest in our communities, including CRA reform, bank mergers, financial access to banking, financial literacy, et cetera. ANHD may be the single entity outside of government that has spent the most time on Signature Bank specifically. We have been working on and advocating around the issues for Signature Bank for more than a decade. Signature Bank's collapse comes as no surprise to ANHD and our members who have long called out their faulty business models which relied on predatory and speculative multifamily activities in New York City. I want to clarify one thing, which is that we've heard commercial lending referenced and commercial real estate, and I just want to clarify that in banking speak, commercial real estate includes multifamily and residential, which I think is a little unclear, but they are all a part of the same portfolio. And Signature's commercial activities really paved the way for thousands of tenants to suffer living in unsafe conditions, be the victims of harassment, or be displaced from their homes and communities. They made part of Signature's practices was for their long-standing core business model to make multifamily loans to bad acting landlords year after year, building after building, knowing that they were underwritten to practices of escalating rents that required displacement, harassment, or building neglect in order to pencil out. The flags were there. ANHD and ERC and many of our members submitted detailed comments with data and testimony about Signature's lending to landlords with public records of tenants' accounts of the behavior, and urged the bank to do better and to address their systemic issues. I'll divert a little and note that Congressman Frank said that their assets were fine. And that they had a great record when it came to housing, and I would respectfully and very adamantly dispute this. He referred to that they didn't have quote-unquote bad loans and that everything was going fine. And that the FDIC was flagging too much of their housing was risky. But I think of note and important of that is risky why? And the riskiness was that they were underwriting to bad debt service coverage ratios, that they were underwriting to forcing out tenants, and that they are, and that this has a incredibly outsized impact on New York City. They are the largest single multifamily residential loan holder in New York City. So it's a disproportionately huge number of our housing units that are impacted, previous by Signature's historic activity and currently. I won't try to speculate or go into the reasons for their collapse, but I will note that some of to the previous point, the issue within the issue were there, and we knew it was there, and it speaks to their willingness for risk. An example, in 2017, Signature gave Icon Realty a loan to purchase a building in Manhattan. Icon Realty already had a history of harassing and displacing tenants. They were already under investigation by the city's tenant harassment prevention task force. They had already undergone a $500,000 settlement around alleged tenant harassment. And Signature underwrote $9.5 million towards a total $17.5 million purchase loan, and from existing public data, the price looked to be an estimated nearly 40 times the current rent roll of the building. And so that's what it would have required for the current tenants to be able to cover the loan that was given. This is more than triple a commonly acceptable rule of thumb. And the concern was clear that these loans were being underwritten based on how an assumption of moving out low rent paying rent regulated tenants disproportionately who are people of color, who are in black and brown neighborhoods, who are in immigrant communities, and who are some of our most marginalized community members and really have nowhere else to go when this happens. Overall, we want to talk about more accountability for banks, that lenders must be held accountable for the impact their lending is having, and how they are supporting and propping up bad actor landlords. We also continue to maintain that we need a stronger CRA, that there's no structural way under the CRA for banks to be downgraded for patterns of displacement in buildings that they finance. Congressman Frank said that they adhered to, we believe that we are probably the group that he was referencing when he was saying he met with housing advocates that were unhappy, and that after some conversations we were happy, and I would say very clearly that that is not the case based on our records. Our last meeting with Congressman Frank was in March 2018. And after signing DFS's multifamily lending best practices pledge at that point in time, in the 4 years after, Signature never fully complied with the agreement. And so it really became a shift of recognizing that the leadership and the management of the bank was not willing to hold things accountable, and so we really needed to be engaging with the regulator and not the bank itself. So I'll turn it over to my colleague, Will, who's going to discuss specifically what's happening on the ground further.
Thank you.
Thank you, Senator.
Reset the time, please.
Yeah.
Oh, they were, I'm sorry, continue the time.
Oh,
okay.
I said they give them 30 more seconds.
All right. Thank you, Senator. So I'm Will Deepu. I'm the senior campaign organizer at ANHD, and I coordinate the Equitable Reinvestment Coalition that Barika was talking about. We really focus on how do we hold financial institutions accountable for disinvestment, wealth extraction, especially in Black and brown communities here in New York City. And as Barika mentioned, many of our members have been raising the alarm for years. They have been organizing and supporting tenants in Signature Finance buildings for many years. And our multifamily best practices is guided by the experiences those tenants have shared with us, and that's helped us develop our policy. An example of the organizing that tenants have done in a Signature building, Signature Finance landlord actually was in 2016. Tenants living in a portfolio of 20 buildings in the Lower East Side owned by notorious landlord Rafael Toledano took to the streets accompanied by elected officials, a brass marching band, and marched from the headquarters of Madison Realty, a private equity lender, to Signature Bank to call them out for financing Toledano. Under Toledano's ownership, tenants have faced a lack of essential services like cooking gas, irresponsible construction that has led to collapsed buildings and high lead dust contamination, and numerous lawsuits against tenants. That's just one example, and there are multiple examples of other landlords that they were lending to. And you can see more of that in our written testimony. And on the same day Madison Realty loaned Toledano $124 million to buy 16 buildings in the East Village. He paid just $97 million for the portfolio, and one of those loans required a $2 million loan required to focus on buyouts or renovations, practices which often trigger huge rent increases. On the same day this mortgage was made to Toledano, Signature issued a loan to Madison Realty Capital with the same portfolio held up as collateral. Now, fast forward to the current. Sure. Now, this is my last point. Now we're in the present. Signature has collapsed. Tenants are worried about what's going to happen to their buildings, what's going to happen, who's going to take over their buildings. We've been coordinating with our members to figure out the buildings and to support tenants. One thing for certain is we need to ensure the voices of tenants are not left out of the conversation, that whatever decision happens to the Signature portfolio must be centered with the tenants' voices. This is why it's important to pressure our banks to do better. We need stronger lending practices to vet landlords. We need regulations that hold banks accountable when they do lend to landlords that harm and displace our tenants. We have the opportunity to stop the cycle of housing being seen as for profit, which leads to many of these conditions, and seen as a human right. Thank you.
Mr. Morrison, last but never least.
Thank you, Senator Sanders, Chair Sanders, and members of the committee. We appreciate the opportunity to testify today. I'm Andy Morrison at New Economy Project. We're a New York City-based economic justice organization. For 28 years, we've worked with community groups and low-income New Yorkers to combat persistent redlining, predatory lending, and other inequities in our financial system and economy that perpetuate poverty, inequality, and segregation. We also work with community groups to democratize finance, land, housing, jobs, renewable energy, and other sectors of our economy through public banking, community development financial institutions, community land trusts, worker cooperatives, and other community-controlled economic development strategies. Today's hearing poses two urgent questions for New York State policymakers. Why did Signature Bank fail, and what can be done to prevent future bank failures in New York? My testimony primarily will focus on how public banking can strengthen New York's financial sector in ways that promote responsible lending, equitable and reinvestment, and racial and economic justice. But first, why did Signature Bank fail? We've heard today about lax regulation of federal and state regulators, the gutting of critical Dodd-Frank protections at the federal level, lack of liquidity, an over-reliance on risky crypto assets, and more. But the simple answer is that the bank operated according to Wall Street's golden rule, which is to put short-term profits above all else. According to the FDIC, Signature's board of directors and management pursued rapid, unrestrained growth without developing and maintaining adequate risk management practices. Its growth was fueled by uninsured deposits, and we heard today that approximately 60 of the bank's clients held deposits, account balances in excess of $250 million, representing about 40% of the bank's total deposits. So when Congressman Frank describes the situation as unpredictable, that's hard to believe. I think anyone could understand the risks involved with having that many uninsured deposits, particularly when so many of those deposits are volatile crypto assets. Predictably, Signature Bank's executives had incentive compensation plans that were tied to return on assets to, quote, reflect additional focus on profitability. That's according to Senator Sherrod Brown, chairman of the U.S. Senate Committee on Banking, which he underscored at a congressional hearing this month. And as you just heard, New York tenants know all too well the ill effects of Signature's pursuit of ever greater profits. For years, advocates have sounded the alarm over Signature's deliberate and widespread multifamily lending to predatory landlords based on a business model of deregulating rent-stabilized units. But we know that Signature Bank is not alone. Many of the banks operating in New York invest heavily in an array of harmful industries, from speculative real estate to fossil fuels. And as this committee knows well, banks routinely push low-income New Yorkers out of mainstream banking by closing branches, imposing prohibitively high minimum balance requirements and predatory overdraft fees, and more. Public banking offers an urgently needed alternative to our unfair, unstable, and extractive financial status quo. Public banks are created by governments and chartered to serve the public interest, not to maximize profits for the benefit of shareholders and executives. They hold public deposits and reinvest in community needs. Through public banking, New York can increase transparency and accountability in our financial sector, stabilize and sustain small community development lenders, and ensure that public banks are not implicated in private banks' destructive lending practices, but instead are leveraged to support local economic development and job creation. Senator Sanders' bill, the chair's bill, the New York Public Banking Act, would create a statewide regulatory framework for local public banking, making it easier for New York cities and counties to establish public banks. Under the bill, local public banks would engage in equitable and responsible lending, following strict financial principles that ensure safety and soundness, and by leveraging public money to fund affordable housing, small businesses, renewable energy, and other community needs, public banks would build diverse loan portfolios that generate reliable returns, minimize risk, and maximize local economic impact. Successful public banks exist around the world, and studies show they frequently outperform private banks in terms of safety, accountability, and profitability. Significantly, it would be virtually impossible for a public bank established by a local government to experience a run on deposits, as occurred with Signature Bank. That's because the local government would be the sole depositor of and would be statutorily obligated to place its funds with the public bank. Public banks would operate similarly to and in partnership with mission-driven CDFIs, CDFIs deploy flexible and patient capital to underserved communities, creating a virtuous cycle of community improvement and social return, even in the toughest economic conditions. In fact, CDFI's sound underwriting and social commitment enabled them to dramatically outperform regulated commercial banks during the Great Recession. So public banks would strengthen New York's financial sector by partnering with CDFIs and other community-based financial institutions to promote responsible lending, safe and affordable banking services in historically redlined black, brown, and low-income neighborhoods. Public banks would provide local lenders with key support, such as liquidity, secondary capital, and credit enhancements to help them expand and diversify their lending. We can look to the century-old Bank of North Dakota as proof of concept. The bank is credited with bolstering local financial institutions through its long-standing partnership model. The BND has a loan portfolio of more than $5 billion, approximately half of which is lent out in partnership with community banks and credit unions. As a result, North Dakota has more local banks and credit unions per capita than any other state, and nearly 6 times the number of financial institutions per capita than the U.S. overall. As in 2008, the federal government has once again taken extraordinary measures to effectively bail out reckless banks, in the process incentivizing further risky and speculative behavior, as was alluded to earlier in today's hearing. New York must lead with forward-thinking policies like public banking that promote safety and soundness, racial equity, and public accountability. The bill I mentioned, the New York Public Banking Act, has the support of a majority of the state Senate and a near majority of the state Assembly. Additionally, more than 100 local elected officials representing 33 local governments from Western New York to Long Island have endorsed the bill, as have 163 community and labor groups from across the state. We urge the legislature to heed their calls and pass the New York Public Banking Act this session. Thank you again for the opportunity to testify today.
Thank you, sir, and I believe that we are closer to a public bank than we have been. I think it's within sight on a personal level. I have a question for you, sir. Let's stay with this issue of public bank, shall we? Let's look at the failure of Signature Bank as an opportunity that could have been the creation of a public bank. Once it was public monies that had to bail these institutions out. Why do you believe that we didn't seize that as an opportunity? We as a society did not seize that as an opportunity.
Well, as you say, we're closer than ever.
Well, and do you believe it was an opportunity, I'm assuming?
Yes, definitely believe it. We believe it is an opportunity, and we agree with you that we're closer than ever in New York to bringing public banking here. I think, as I think everyone knows, the opposition to public banking is really Wall Street, the Wall Street industry that opposed it. I think actually the banking lobby is really the only organized opposition to the bill. So what we would like to see is for the legislature to be more responsive to the masses of people who've weighed in support of public banking, and less concerned with some of the bad faith concerns that have been raised by the industry.
Let me press you a little further. I'm not sure if you heard what I heard. The superintendent spoke earlier, and she was taking credit, as she should, for the amounts of money that she returns to the people of New York State every year. If one figure was $1 billion, another figure was 200 and some odd million. It seems to me that that was an opportunity also for a funding source of a public bank. Did you see that also?
I did. I actually wrote it down right here. I said $1 billion in enforcement to state, and then I have an arrow, use it to seed public banks. So we're on the same page, Senator. And
well, I was looking at you, sir.
No, it's a great idea. It's exactly, there's a real policy rationale for using those funds to support public banking, since public banking would remediate a lot of the harms that have been wrought by the big banks by investing particularly in black and brown neighborhoods that have been historically redlined. So it would make a lot of sense to use that as a funding source to seed public banks around the state.
Of course, not the only funding source, but a worthy one that I will take up with her and to others to say, it's a public good. If you're doing good for the public, then let's do a public good. Let's
you.
see. Where do you start? I saw a bunch of stuff here. Let me tell you all, I am very much open to legislation. If you find some ways that we can make sure that the people of New York State are protected, and that bad characters are not getting away with stuff, please let me know. It was said earlier, and I'll speak to your organization now, a touchy one for you, but one of the people who testified was saying that they spoke to neighborhood housing groups, and that conversation went well, or some words to that effect. When was the last time that your organization had a conversation with the speaker, and if it wasn't in the last 3 or 4 years, did you guys make an effort?
I'm trying to think when the last time we and our members talked to Signature directly.
Yeah, I think it was before the pandemic started. There was our tenant groups had had a roundtable to bring up the conditions in the building. This was before my time at ANHD, but what I can say from my report back and from what I spoke to tenant groups about, there was a lot of pushback from the bank around the conditions, where really at one point a tenant had to show on Zoom, like literally turn the camera to show the conditions in his building.
I will also note that the efforts to have direct conversations with Signature, to their point, just because you as a bank are having conversations with neighborhood-based housing groups and housing advocates doesn't mean that they're productive or successful conversations, or that you're addressing or remediating the issues. And I know for a fact, one of the extreme and extraordinary steps that we took around the work and efforts to get Signature to address their multifamily lending practices was becoming shareholders of Signature, so that we could be fully informed and attend and engage in their shareholder meetings as a way of being able to directly engage with management, because there were times that we were being shut out or they were not willing to have conversations with us.
I guess that was a point of privilege where when I hear vastly different statements take place, I try to err on the side of surely there's something else, some logical. Anyway, bank failure within a bank failure, is it? How do we stop this stuff? Signature Bank being an example. How do we? Several things have happened. First things I want to point out is that it seemed that the FDIC should have moved on this earlier, and I'm not really getting a good reason why, but are there enough laws, are there enough reasons, if people are saying there is a Signature Bank is such a bad player here, was there not enough regulation or laws that we could have moved to say, Signature Bank, clean up your act, or you're no longer you're using public monies? I guess that's on you, and I'm not sure if that's totally you.
Yes, thank you for that question, Senator Sanders. From the federal point of view, that's what I can speak to. I realized I didn't say earlier, Americans for Financial Reform Federal Advocacy Group made a coalitions actually in response to the 2008 financial crisis. And I wasn't there, but you know, I know the group and over 200 coalition members, labor union, consumer groups and such were pivotal in passing Dodd-Frank. But the answer is pretty simple. Banking is inherently, right, we know what it is. Like, it's inherently risky, but
Okay.
it's one-on-one, and there are very few, there are very simple answers, one being high capital requirements. Dodd-Frank tried to do that with their bill, and having higher requirements for larger banks. Like I discussed in my testimony, 2018, on the 10th year anniversary of the financial crisis, they rolled back some of those capital requirements for banks the size of Signature and, you know, Silicon Valley banks within those peer groups, right? Higher capital requirements, higher liquidity. One of the main causes of a bank run is just, well, not cause, but catalyst, is liquidity. If people are asking for their money and you don't have it on hand because we have reserve fractional banking, whereas, you know, I give 100 and JP Morgan Chase, that's my bank, they hold on to $10 and lend out the other 90. That's banking inherently, and because of it, there are some protections which we know from the Great Depression, really, as to how to mitigate those things. So we have capital standards, we have liquidity standards, we have, and even after Dodd-Frank, and right now the Federal Reserve is going through what's known as Basel Endgame, which is the implementing the recommendations from the the global standards that was set after, again, the financial crisis. They're still not as high as what many studies have shown they could be and should be, especially for the sizes of these banks. And you know, the last thing I will say is on like planning on what actually happens when these large banks are at the brink of failure. The answers are not hard, it's just really the political will to do so. And as I believe Andy said, beating back the lobby from, you know, these huge conglomerates, because they engage in these risky behaviors, which leads them to higher profitability, which then leads them to able to have an army of lobbyists in DC, which then further fuels their risky behavior and rules because they get lax rules, and it just becomes this self-destructing cycle while the rest of us pay the cost of it. But it is definitely stoppable, and it's not hard to stop.
Let me underline your point. In around, I don't know, 2003, I was at the City Council of New York, and I authored the strongest anti-predatory lending law in the nation. And the banks came to me and said that they couldn't do it. Okay, why? Because their money was securitized and all over the place, and they could not separate dollars from one another. I reminded them that we're separating these dollars based on money laundering. And I said, surely you're able to do that, are you not? And they, of course, agreed, yes, we can do that. Then I said to them that we can do this. Make a long story short, we passed a law in New York. I worked with them for the longest, trying to get them to do, even as we were working with them, they were running up to Albany trying to make sure that I couldn't do. So we passed and passed that law, and they took us to state courts and overturned it. For whatever reason, the City Council did not fight that. I have my own, let me do it different. The leaderships did not fight it. I have my own suspicions, but I've been accused of being suspicious. I did tell the banks then, I said, you guys are going to rue the day that you did this. I had no idea that just a few years later, the House of Cards would collapse on them and almost take the world with them on them. Somehow I'm just getting echoes of the same conversation. It seems like I'm hearing the same people. You'll save me from this, Mr. Bell.
Well, yeah, if I could just add, so the banking industry is a highly consolidated industry with many very large institutions. And so during the Dodd-Frank debate, there was a bill to break up the big banks. They said, maybe this has gone too far. We've got too big to fail institutions, that if they do fail, their resolution plan is basically a fairy tale, and they will throw themselves on the backs of the taxpayers at that moment. And that could happen again. It's happened in a major way in that period. So I think what we have to realize is, you know, as community groups, we have a seat at your table. Like, you invited us in here, consumers and small businesses and neighborhood groups. We're not without power. And New York is one of the states where people can face down some of this, you know, concentrated power of the banking industry and say, we have to have a system with sufficient oversight and supervision to prevent contagion and a full-blown banking crisis. So that's job number one, is there has to be effective oversight, consumer financial protection and regulation. But the second thing is there's enough business here to go around to include the CDFIs and the community-based institutions and the public bank. There's voters who support public banking in New York State. They would like to see their municipal deposits go into a local public bank. They should have the opportunity to do that here in New York State. And so we're excited to work with you to push that forward. But I think it is really important to realize that we, the consumers and small businesses and neighborhood groups, we're the constituents and the customers of the regulatory system. It's not the banks. Like, when we were lobbying on this bill in 2018, we would go and see these senators from some of the states, and they would say, well, I've heard this from the regional banks in my area. Here's what they want. They didn't ask so much what the customers need and what the customer wants, and how the banking, you know, how is the banking playing out in the community, as NHD has just described. That's the bank failure within a failure. It's like, even when things were going well and it seemed like Signature Bank was healthy, the lending activity was actually hurting tenants in New York City. So we want to change that in New York City and have banks that are accountable to the public, whether they're private or public institutions, which we think will have a better chance at holding accountable to the public. So that's why we strongly support your bill and have so many organizations in support of it, and really hope that it will get to go forward to a vote in this session. Thank you so much.
Okay. One of the, even as we speak, probably already happened, one of the bills, there are 3 bills out for public banking. One of the bills, why don't you check and make sure that my words are accurate, Paul? One of the bills has been voted out of the Senate even as we speak. We really need to see these 3 things to not compete against one another. They're asking different things. And if we could just get one of these things to pass, it makes it easier for everything else to pass. There I go thinking again.
Senator, if I could just add one thing to what you're
means.
saying, because I think one of the pieces
You
that John
checking
just
on that?
highlighted is just convened.
Oh, they just convened?
Okay, got it.
Oh, okay.
Well,
So when I
maybe
leave
we need to
here,
get you over there.
Yeah.
But I think one of the things that all of us, across all of us, know and speak to for our experiences is similar is the clients, right? The folks who are impacted with this are the folks in neighborhoods, small business owners, residents, families who want to get a mortgage. One of the things that we run into constantly is some of the areas that are disproportionately impacted by this activity, by these banks, are the same neighborhoods that that they're closing branches on and leaving unbanked or underbanked, right? And so I think there's an important piece in here of the voice and the ability to move things in collaboration with you and with the legislature in New York City, in other places, federally, nationally, what have you, for the folks who are really the victims, for lack of a better word, of what happens when banking fails and when it doesn't serve and support certain communities and certain neighborhoods. Need to be able to advance things like public banking, like a Responsible Banking Act, like requirements of small business and micro and BIPOC and immigrant business loans, which we saw during PPP, where entire swaths of New York City's small business community didn't have access to small business, like the safety net, the lifeline. And we know that that happens consistently across the board.
I see you and I raise you. I think that we also need to look at the question of these fines that corporations are often hit with. Many of these fines are based on communities, the environmental justice communities. I love this stuff. And yet the fines sometimes go to the general fund or every place but the place that I saw it with predatory lending, where these companies were getting hit with these fines and they were going to the general funding, and the governor at that time was using his discretion to give the monies, and which meant that the communities that got hit the hardest received the least amount of the money. We really have to work, Paul, we really have to work on legislation of that nature, which says the fines must go back to the community that generated the fines, if you wish, or where the problem was located. The fines, at least half, maybe some, version of that, at least half of that money must be reinvested, and perhaps we should go a step further and say, should go to a CDFI or something of that nature, because that way, not our governor, who's a great person, a bad governor could use it to do whatever they want in any way that they want to do it, and of course not ours. But we should make sure that it goes to do something positive. That would be a good piece of legislation that we came up with, Paul. I'll turn us 100% back to Signature Bank. One of the problems of Signature Bank was misinformation. You had the speculators and their blog lines went crazy on it. I worked my way this way. I'm working with, no. Okay, I'll tell you what. You were jumping. You both were jumping.
Well, I think.
What do we do about this?
I think good corporate governance involves understanding that is a risk. It's an increasing risk in the environment that we're in.
Okay.
And that the board of the banks and the regulators need to come up with methods to try to deter that type of activity, but also to guard against it, perhaps by having stiffer capital requirements, as some of the speakers were suggesting. So I would agree that it's an increased risk in the environment, and I don't think we've seen the end of it. I think we will see additional problems of this nature. In this case, you had sort of a perfect storm of different bank failures and the FTX situation that collaborated, but that's not unusual in the economy. If you read the business pages, there are failures of various kinds, and the way that people get their information now, instantaneously through Twitter and through social media, means that this type of a risk is a greater risk for financial institutions in the U.S. economy.
Thank you, Senator. I'll quickly say, and I understand your question, but to be frank here, the social media piece that a lot of lawmakers, especially at the federal level, is harping on is a bit of a red herring. A report came out today that I believe over 60% of Signature's deposit base were actually business, commercial deposit holders, not average. This is not going back to, what was it, Robinhood and Wall Street Bets, where a bunch of guys are on Reddit and just trading information and cause this to happen. Complete opposite. These were very informed businesses, large, whether, medium, small businesses, and, who made, I think one presenter here said it today, rational decisions as to why they took out their deposits, which was reported on Signature's financials were reported on, way in advance. I believe their financial statements had come out previously a couple months before. So again, if you have the right protections in place, right? You have proper growth risk controls, you have capital requirement, all of that. Your bank is not, merger guidelines, all of these things that we know are prudential standards to regulate. People, the social media taken out, that is not going to cause what it caused. And I think it's a way of trying to, not your question, of course, but others who have stated, and deflecting from the true issues at hand. But yes, thank you.
Now, my friends, only because I need to be someplace in case a debate comes up on this, which I would really love to debate someone on this, but the public banks, of course. I'm going to allow you to have 30 seconds to make your final statement, whatever you want to say on the failure of Signature Bank. I started with you before. I will go back to you, sir.
Well, Senator, I'll just use my time to say thank you again for inviting us to speak. We're eager to continue working with you on proactive solutions, including public banking. We do want to, stress that we think the need for enacting legislation to actually facilitate public banking is sorely needed this session. So we urge the legislature to move on the New York Public Banking Act in addition to any other public banking legislation, not to let that one fall by the wayside for another session, another year, waiting for, when there's all this opportunity to turn the corner on our predatory financial system and create public banks that will be responsive to community needs. So we hope that the legislature will heed those calls from us and many others and pass the New York Public Banking Act this session.
Thank you again, Senator, for having us. I just wanted to emphasize the thousands of tenants that are facing horrific conditions. A previous speaker said that, oh, everything is fine, like he joined Signature Bank because of their affordable housing. I think he should talk to the thousands of tenants that are facing horrific conditions that have continued to face from Signature finance loans lending to bad landlords. And we can have stronger, thinking federal level, a stronger CRA that's race conscious, that has down rates for displacement. It's interesting that a civil rights act that legislation is race blind. We need a race conscious CRA.
Thank you, Senator. I would echo what everybody up here has talked about today and some of the points. I would lift up and say we would love to work with you around stronger enforcement because too often this falls by the wayside. And I would, on behalf of ANHD and our members, encourage you and the legislature to stay involved as we have to ensure that the disposition of these multifamily loans are done with the utmost care and attention of ensuring their affordability, safety, and soundness for their tenants.
Thank you, Senator Sanders. I'm going to echo a lot of what has said and really to say that we would love to continue, AFR would love to continue working with you all on the federal level. You all are the constituents to, our new minority leader, Hakeem Jeffries, Senator Schumer, and you all are the voices that they want to hear from. And on all of these issues, I'd love to continue this partnership. Thank you.
Thank you, Senator Sanders. I would say that the banks that were the size of Signature Bank that were exempted from the harsher requirements for stress testing and resolution and plans and so forth, they are systemically important, and so it's important that they be subject to strict federal and state supervision and enforcement. We need to make sure that lending activities for housing are successful for the people that are living in the housing. I feel very strongly about that, given the affordability crisis that we have. But I'm also concerned about, with the phenomenon of remote work and the large number of lenders who are exposed to commercial office building loans and the rising interest rate environment, there's vulnerability in that area. And so we need our regulators to keep an eye on that, and we may face continued stresses related to that. So that's something the regulators really have to keep an eye on. Thank you so much.
I am keeping my eye on the commercial problems that are bubbling up there and what this may mean to the banking system. We probably will do a hearing on that. We probably will do a hearing on the CRA. I would be remiss if I did not give a commercial at this time. We're doing a banking tour of New York State starting on the 11th. We are starting in Buffalo. We will go to Utica, Syracuse, Rochester. I probably have missed one or two. And we're going to hear, but we will also do the interaction of that in what's called MWBE, Minority and Women-Owned Business Enterprises, of which I wrote the laws in New York City and helped do it in New York State. So in the morning, we'll do some banking. In the evening, we'll do some MWBE. It's quite the tour. If anybody has nothing to do, come on. It's plenty of room up there. We'll leave the light on for you. So, having said that, my friends, I do not believe that this is the last time that we'll have the pleasure of speaking, and I will engage with making sure that the tenants are not just, go from bad to worse, just forgotten and then thrown to wolves. I, of course, have to figure out what is the purview of the banking committee and working in harmony with the other committees that are out there. But having said that, my friends, I trust that you have found this hearing useful, that it has been enlightening, that we have made a point to say that the Senate is going to be a player in the lives and we are the direct representatives of the people of New York. And as such, that we will not be silent as major banks go down the drain or as they not fulfill their requirements, obligations. We are going to look into all of the matters pertaining to banking in our great state, and we are going to hold more hearings. The summer is not the end of what we do, but some may say it's the beginning of the things that we do. I want to thank you for coming out there. I thank you, my Brooklynite friend, for taking a sojourn up to Albany. I'm glad that you found it. Don't be a stranger. We'll give you some more opportunities to come on up here. We'll do it when it's warm, though.
She's from Washington, D.C. She can't.
Yes, incredible. They used to call that.
Well, I'm not from D.C., I'm from New York.
She's from
I just
Brooklyn.
live there. Yeah.
Brooklyn. There's a twinkle in their eyes, sir. People from Brooklyn, you'll spot it. I am not. There's no twinkle here. Anyway, which brings us back to this point. And that point is that we are going to thank you all for being up here and really putting in perspective that needs to be said. This is being taped, and I assure you is being watched by a multitude of people and a multitude of interests. And I'm sure that they will find all of your words either comforting or discomforting. Having said those things, I'm going to rush back. I want to thank my staff. Thank you for sending that to me. Paul was my ESP guy, sent to me. I want to thank my staff, you, Paul Alexander, and you, Sam Fine, for helping to make sure that this was a real good hearing. I want to thank all of those people in that audiovisual room back there who struggle hard to make sure that I look less gruesome. I really appreciate that. And of course, I want to thank my friends who must put it in prayer every time I sit before the mic. So I appreciate your prayers back there. Having said that, my friends, I'm going to go. I've got a little fighting to do, and I look forward to seeing you all on the front lines. God bless you all. Have a safe trip.